Welcome to the European market open a minute to go until the start of cash equity trading. I'm Tom McKenzie in London. Here are your top stories. Earnings come thick and fast. Big banks and big oil dominate the week with inflation, supply chains and the energy crisis in focus. It is, of course, Fed week. The FOMC gears up for another jumbo hike with inflation at a 40-year high. But the latest MLive Pulse survey says the mission to tame prices may drive the US economy into a ditch. Stocks sell off. Let's take a look at the futures then. You are down currently across the Asian space, despite the fact that there is some relief around the real estate sector in China on plans potentially for a fund to help support that sector. You had some weaker data out of the US towards the end of the week in terms of business activity back to levels last seen at the front end of 2020. Futures pointing lower by 0.5%. Let's see how things will open up, of course, on the week where we are expecting that 75 basis points from the Federal Reserve. But will they be hiking into a recessionary environment? Just how far and how fast can Jay Powell and team go? The Spanish IBEX is currently down 0.4%. The FTSE 100 down 0.2%, off by 11 points. We continue, of course, to watch the two contenders to take over from Boris Johnson. There is a televised debate later this evening in the UK between Rishi Sunak and Liz Truss. Let's switch it on and see how things are playing out then across asset, of course, around the dollar strength. It is risk off. You've got to move into, for example, treasuries across the curve stateside, and yields are higher there. In terms of what's happening across the futures, you're looking at losses of about 0.1%. US 10-year currently at 278. That is a move higher of about 4 basis points. So in fact, money moving out, I should say, of the US benchmark. 278 yields up. In terms of what's happening across the Bloomberg dollar index, you're seeing gains just of about 0.1%. But of course, within the history, within the context, you're still at very high levels for the greenback. And Brent 102 off by 0.6%. Let's get back to what's happening then in terms of the lead up to the Federal Reserve decision. Fed Chair Jerome Powell and his colleagues are expected to approve another 75 basis point hike this week and signal their intention to keep moving higher in the months ahead. So just how high will the Fed go in this hiking cycle? If a recession sets in, will the Fed keep raising rates regardless? And does that mean the dollar has reached its peak? Here's how investors responded to the latest MLive Pulse survey.
We think the dollar can still rise further. We think the DXY will move up to around 112.
The dollar has been coming down, and I believe some of that in the fact that the ECB is potentially going to be increasing their interest rates and shoring up the euro.
In some ways, our expectations call for a leveling off of the dollar relative to other global currencies.
I don't think that there are expectations among Fed funds futures that that the policy rate is going to rise by more than 75 basis points. And if that's the case, I think the dollar strength could start to fade.
The broader dollar may slowly be reaching its peak here.
In terms of the dollar rally, there is scope for it to rally further, but there are some things on the horizon which could cause it to hold back.
If the Fed doesn't back down at the September 22 meeting, there is a possibility that the euro dollar could fall back towards record lows.
Okay, let's get into the key market drivers then with Venram from our MLive team and Whaley, BlackRock Global Chief Investment Strategist. Venram, let's start with you then. Just the determination of the Fed and the FOMC to drive through and back to that 2% target. Is there anything around the data that's coming out of the US that will give the FOMC pause for thought at this point?
Morning, Tom. The short answer to your question is no. I think that if inflation continues to be stubbornly high, and we got a 9.1% for print for June, as you know, that's nowhere near the Fed's target. So the Fed will continue to raise rates if we continue to get prints like those. One of the big mistakes of the 1970s was that the Fed paused hiking too soon when the economy fell into a recession. And that message won't be lost on today's Fed. They are not going to be spooked by a garden variety recession here.
They're not going to be spooked at this point by the threats of recession. Of course, we continue to weigh up, if indeed we get a recession, what kind of recession that will be. Then when it comes to yields then, we've seen them grinding lower, in fact, since about mid-June. I'm looking at the 10-year, currently at 278 from the highs of almost 350 back in June. Have we topped out in terms of yields stateside?
I would think so, because particularly for the longer dated yield, that may be the case. The 10-year trajectory is predicated on how resilient the economy proves to be. At the moment, the path of least resistance is for the 10-year rate to decline towards 345 or 350 thereabouts. What that will essentially mean is that the 3-month 10-year curve will invert, heralding some kind of a recession over in mid-2023. And that is the leg that the markets are pricing in currently. And therefore, I do think that the 10-year yield perhaps has topped out, assuming that inflation expectations are going to be under control from here on.
And we're going to be getting that University of Michigan survey out towards the end of this week on those inflation expectations out of the US. Venran, stay with us. Let's bring in Wei Li at this point, of course, from BlackRock. Good morning, Wei. What do you make then about the concerns from some that this is a Federal Reserve that's going to be hiking ultimately into a recessionary environment?
Well, that's the tough trade-off between growth and inflation in this world that is shaped by supply that have yet to be acknowledged by the Fed or the ECB for that matter. So if you look at the Fed's forecast as well as the ECB forecast, they don't seem to acknowledge that the very aggressive rate hikes that they're putting forward could have significant impact on growth. And the moment that, for as long as they don't acknowledge that, we do not want to chase any bear market rebound, because any incoming data volatility could quickly kind of pivot central bank pricing to be more focused on the politics of inflation, which is ever tightening policy and rate hike signals.
There's nothing about the global equity rebound that we've seen in the last month that will convince you and the team at BlackRock to change that view?
If you look at the forecast of the Fed, they are essentially expecting inflation to come down by itself. And we believe that actually in order for them to bring down inflation, they have to slam down kind of spending and the demand side of things significantly. That's in the case of the Fed. And if you look at the forecast of the ECB, they are actually not expecting a recession, and we are, right? So it really feels that they are hoping and expecting a soft landing, when in reality, given a very, very tough environment that we're in right now, that is very much characterized by supply constraint, we're not going to have both. It's you have to choose between growth and inflation, and the trade-off is so much tougher in this environment. And it doesn't feel to me that central banks are acknowledging that at this moment, as they continue to focus on the politics of inflation rather than the economics of inflation.
Wei Li mentioning there, bringing up, of course, the ECB, where the challenges arguably are even more acute in terms of these trade-offs. Is it possible for the ECB? Are they able, now that they have this TPI tool, to address the kind of concerns that we see in Spain, but most particularly in Italy? Does that give them the cover to hike faster and harder than maybe the markets are starting to price at this point?
Continue to hike at least into the year end. And the markets are at the moment pricing in about 100 to 120 basis points of tightening. And that is kind of lost on the bond markets, I would say. If you look at the front end German 2-year bonds, I think we are at 0.45%. That is kind of taking an extremely pessimistic view of where the ECB will end up in the cycle, because we are already at 0% on the deposit rate. By September, we will get to 0.5% at the very least. And therefore, German 2-year bonds are not reflecting that currently, and they are showing extreme pessimism, which I think is a kind of a mistake.
Okay. Okay, extreme pessimism being reflected in German bonds. Currently, BTPs, by the way, trading at 330. So not a sense of panic there across the Italian debt space at this point. Waley, just in terms of where this leaves, well, your views. I mean, you outlined this in your notes to us, Waley, around whether or not the TPI tool, that anti-fragmentation tool that was unveiled by the ECB at least partly last week, whether that was going to underwhelm or overwhelm markets. What is your assessment of where it came through on that?
Well, so far, it seems to be quite powerful in terms of scope, but at the same time, it also kind of adds on top of the existing ONT that ECB already has. But the risk here is really that if that emboldens the central bank to hike faster, and in fact, actually, after last week, our assessment is that the risks of recession in the euro area have actually increased.
And you don't buy the view that this gives them cover to hike faster?
We actually do think that this could embolden them.
Right, it could embolden the ECB despite those recessionary risks.
Yes, indeed. And in fact, recession in euro area, especially given the 70s style energy crises, is actually now our base case at this juncture.
Okay, a base case for a recession across the Eurozone. Waley, we're going to get some of your calls on earnings after the break. Thank you very much indeed. Ven Ram, of course, from our MLive team. Waley, BlackRock Global Chief Investment Strategist. Again, more calls from Waley in the next couple of minutes. Coming up against the backdrop of soaring inflation and a potential recession, we are going to look ahead then to the European earnings reports, which are in full flow this week. Stay with us. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Welcome back to the Open. We are 12 minutes into the European trading day. You're seeing losses of 0.2% across European equities. You're seeing the selling, most of the pressure over in the DAX, down 0.3%, but really this is kind of investors weighing up, of course, those concerns about the outlook for growth, recessionary concerns, as earnings come in thick and fast. We'll be discussing that, breaking that down just in the next few seconds. Future stateside range bound in the S&P E-minis, Nasdaq futures gaining just a little under 0.1%. Let's get back to some of the individual movers then, talking of earnings season, and there is a slump when it comes to the wealth manager of Switzerland, of course, Julius Baer. They missed They have seen many of their clients on the sidelines over these concerns, of course. It was a 26% drop in revenue in terms of Julius Baer. They did say that they're starting to see a little bit more momentum coming up, but trading volumes, trading flows, a disappointment for that company. When it comes to Ryanair, you're seeing just a loss of 0.7%, despite the beat in terms of the revenues there for that company. They are saying the picture going forward looks very, very uncertain indeed, but they managed to avoid the worst brunt of some of the chaos that we've seen across the airline sector this summer period. When it comes to Philips, look at that big drop of around 10%. The medical gear maker, of course, second quarter earnings missing. Inflation, of course, an impact, the China exposure, and importantly, and this will be playing into the drop that we're seeing on the stock today, lowering their sales guidance for the full year as well to 3%. That is down from a previous guidance of 5%. For a lowering of guidance really hitting Philips this morning. Now, it has been a busy week for quarterly earnings, and it will be a busy week with some of Europe's biggest banks reporting, as well as oil giants, airlines, and automakers. Investors will be looking out for how inflation, the energy crisis, and supply chains play in to those quarterly earnings. For more, let's bring in Bloomberg's Leo Kenstarper. Leo, Wall Street banks then have yet again reported pretty impressive fixed income trading revenues this season. Are European peers likely to perform similarly, or are the differences in these regions going to be pronounced when the data comes out?
Deutsche Bank should be able to beat expectations of 19% growth in fixed income trading, but it might not achieve the 30% growth that US peers have reported. And Credit Suisse has already warned of a third straight quarterly loss, so investors are not getting their hopes up there. What could be a bright spot for Credit Suisse could be its relatively resilient fees from advising on deals, as flagged by the bank in its latest profit warning.
Okay, so looking for the deals around that lender. When it comes to Unilever, pressure then to pass on some of these costs to the consumer, to the customer. They've been able to do that in previous quarters. Are they likely to be able to do it again?
Yes, Unilever has already raised prices in the second quarter, probably by 9%, and further price increases are expected in the second half. Unilever has also guided that its forecast will be in the bottom end of its range. Its profit margin will be in the bottom end of its forecast range. So profit is already taking a hit from inflation there. And what could help Unilever is M&A. The company has this month added activist investor Nelson Peltz to its board, and this should help speed up disposals of slower growing brands.
Okay, we've seen a softness in oil prices in the last few weeks. WTI now at $93 a barrel, well below 100. But of course, broadly, the commodity markets remain relatively tight. The implications then for companies like Shell and how they navigate that environment.
Yes, Shell should have benefited across the board. The oil, power, and gas segments should have all been boosted by price jumps this year. And this is why the focus will be on capital returns plans for the second half. Shell has already completed an $8.5 billion share buyback program in the first half. And now Bloomberg Intelligence expects at least another $6 billion buyback program for the second half.
Okay. Bloomberg's Leo Kenstarper on some of these equities and earnings to watch. Thank you very much. Let's bring back Wei Li now, BlackRock Global Chief Investment Strategist. Wei Li, the earnings that you've seen so far across this season, how have they changed the Wei Li view of the world?
Well, so far, it's still early days, but earnings have been reasonably robust, supporting the bear market rebound that we have seen in the recent weeks or so. But our view on earnings for both the European equity market and also for US equity market remains to be that the expectation for this year is too optimistic versus the reality on the ground. If you think about we're expecting recession in Euro area, markets are not pricing that in. So far, year to date, equities are reflecting rate repricing, but they are not reflecting growth stalling and coming to a halt. And if you think about some of the drivers of earning, margin pressure actually has been increasing. If you look at rising labor cost, if you look at rising production cost, and the difference between CPI and PPI, raising questions about the ability of companies to pass through some of this rising input costs to their end products, all of that raising questions, and the raising rate environment, raising questions around the kind of how long margin can stay at this elevated level. So our expectation is that earning expectation for this year is too optimistic versus what is being is what should be the case, and we continue to be somewhat cautious around equities.
And a recession in Europe is now your base case, and you're saying that isn't fully priced in yet to European equities. What is the gap there? I mean, how much more of a drawdown could we see then to get that pricing in?
Well, just since we're talking about earnings, markets are expecting still high single-digit growth for European equities, but given the recessionary environment in Euro area, we think low single-digit, maybe even zero earnings for 2022 is more likely the case.
Where are you still finding pricing power?
Where do we still, well, energy sector, for example, has been somewhat resilient. Yes, of course, oil price has come down, but because of the very tight market, this is a sector that we still want to own. And some of the other sectors, thinking about barbelling, quality, and somewhat defensive, healthcare stands out, both in the case of Europe as well as in the case of the US.
We've got some big tech earnings. And I'm not going to get your views on individual names, but of course we have the likes of Amazon and Apple, Alphabet as well, Meta later this week. What do you do with technology? How much distinction do you have to make between those that have heavy exposure to advertising models and those that are making the equipment and software that is in demand?
Well, tech as a whole have been coming under pressure as focus on rate and rate sensitivity dominates kind of markets so far this year. Over the strategic horizon, we do still want to own tech as part of the portfolio, but tactically, given so much uncertainty around kind of policy, around rate response, around growth, recessionary kind of outlook, we wouldn't necessarily be wanting to jump in and buy in the dip in tech sector. But to your point about kind of differentiating the light and the heavy parts of tech is one way to be more selective in this current environment.
How do you hedge when it comes to credit, the role of credit in terms of hedging some of these risks? What do you want to be adding at this point?
Well, investment-grade credit overall is our current high conviction.
Is there still value there?
There is still value there if you think about in the context of just for how long these parts of the market have not been giving you yield, and for the first time in over 10 years, they're giving you income. And at the same time, in terms of the default outlook, we're expecting somewhat contained and benign default outlook, even as we head into an environment where growth is going to be scarce to come by. So we recently upgraded investment credits and used the downgrade in developed market equities to fund this upgrade, all at the same time thinking about a whole portfolio context. So when we upgrade credit, we need to think about kind of where we found it from, and that is a bit of a pivot towards duration in portfolios that we implemented recently.
Whaley, always fantastic. Thank you very much. Have a wonderful week. Thank you for coming to the studio. Whaley, BlackRock Global Chief Investment Strategist there. Just one view on the importance, at least the opportunities around investment-grade credit at this point in the market cycle. Right, coming up later in the show, Julius Baer's profit slumps as wild market swings spook clients. Don't miss our interview with the bank's CEO, Philip Rickenbacher. That is coming up. This is Bloomberg.
what's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Welcome back to the Open. We are 23 minutes into the European trading day. You're seeing losses of 0.5% across European equities. We have a redhead across the terminal. The ECB's Kazex, of course, from the Bank of Latvia, saying that big interest rate hikes may not be over. That's after, of course, the ECB pulled the trigger on 50 basis points last week after previously flagging 25 basis points. Again, the ECB's Kazex saying that big interest rate hikes may not be over. Also saying that a 2-week euro is a problem when it comes to the single currency. Just checking, it's currently trading at 102 in terms of the trading session today, just a gain of about 0.1%, so a bit of movement on the back of that line. A couple of other points from Kazakh saying we should be open to discussions on bigger hikes. Again, on his concerns about a weak euro. September, the hike needs to be quite significant. So, of course, looking ahead to that September hike from the ECB, and one of those voices then saying that bigger hikes may not be over. Looking ahead possibly to another 50 basis points for the ECB. At least that is the view from the Latvian central bank governor, of course, on the board of the ECB. Let's get the Bloomberg Business Flash now with Alice Atkins. Alice.
Morning, Tom. Ryanair has reported a first quarter profit after dodging the worst of Europe's travel disruption. Europe's largest discount airline posted adjusted net income of 170 million euros for the 3 months to June, ahead of estimates. But the carrier says it's cautious about the outlook beyond the busy summer season.
We're fully staffed, so we're flying about 115% of the capacity that we had pre-COVID, and the plan is to grow from 149 million customers pre-COVID to 165 million in the current financial year, which is up from 97 million last year.
Philips shares have slumped after it cut its sales guidance as inflationary pressures, supply chain troubles and COVID lockdowns in China led it to miss earning estimates in the second quarter. The Dutch maker of medical gear now sees sales growth this year of as much as 3%, down from an earlier estimate of 5%.
The second quarter was impacted by a lot of headwinds. We had China lockdown, supply issues, and rising inflation. We have taken decisive action in terms of further improvements on the supply chain, as well as productivity and pricing. We see for the second half of the year a 6 to 9% growth.
Porsche boss and VW lifer Oliver Blume is set to become Volkswagen CEO after the German car maker ousted Herbert Diess. According to sources, Diess's clashes with labour unions and missteps on key projects spurred the shake-up. The change at the world's second largest automaker marks a departure from Diess's combative style. That's your Bloomberg Business Flash. Tom?
Alice Atkins here in London, thank you. Coming up, it started as an act of protest by fed-up apartment buyers in a single project in a city in central China. Now tens of thousands of people around the country are withholding payments on their mortgages for homes that developers have yet to finish. We get the latest and the implications politically for the leadership in Beijing. The markets are currently lower here in Europe by 0.4%. Futures stateside pointing to losses of 0.1%. Stay with us. This is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Earnings coming thick and fast. Big banks and big oil dominate the week, with inflation, supply chains, and the energy crisis in focus. It is Fed week. The FOMC gears up for another jumbo hike, with inflation at a 40-year high. But the latest MLive Pulse survey says the mission to tame prices may drive the US economy into a ditch. Stocks sell off. Let's check in then on these indexes. Yes, you're seeing something of a sell-off across European equities. We're adjusting, of course, to slightly weaker data out of the US, particularly on Friday, coming through. Business activity dropping to levels last seen at the front in the early side of 2020. We're looking ahead to the University of Michigan survey as well towards the end of the week. But of course, that Fed decision, of course, the markets are expecting 75 basis points from Jay Powell. Here in Europe, looking ahead as well to inflation data towards the end of the week and just how much of a conundrum the ECB is in after unveiling that anti-fragmentation tool. Again, across the European benchmark, you're seeing losses of 0.4%. Selling over in Germany, the DAX is down 0.6%. Across the sectors, a bit of relief around telecoms. Vodafone is at play there. The FTSE 100 down 0.4%, a drop of 26 points. The politics in the UK still front and centre, of course, in that debate between the two leading candidates to take over as British Prime Minister later tonight. Let's take a look then at which sectors are on the move. I did mention telecoms on the back of what is happening around Vodafone. It was a beat for that company. They did pretty well in Spain, the UK, a bit of a hitch when it comes to their services exposure in Germany around some regulatory front, but overall it was a beat for that company. So telecoms currently up 0.4%, just three sectors in the green this Monday morning. Utilities also gaining 0.3%. Personal care and drugs, there you go, healthcare has just edged into the green as well, one of those defensive sectors the number of our guests say they want exposure to at this point. Energy is down by 1%, autos also taking a hit. We have that fascinating story around VW. Let's check in on some of the individual movers because, of course, we are continuing to weigh up the earnings picture as we flag some big names reporting here in Europe, but also the tech giants stateside as well. Let's get to what is happening then with Julius Baer, the Swiss, of course, wealth manager. And it was a disappointment. Their revenues fell around 26%, the stock taking a hit on that. Uniper as well, of course, that major utility in Germany that's in the process of receiving a bailout from Berlin. They are not withdrawing, they're not taking additional gas supplies from storage. So storage levels are reeking up. Again, the Russians did return those volumes back to 40%, but of course the fate of Uniper remains something of a murky picture, again, as lawmakers line up that support for that company. Philips, that was a miss, and downgrading, and this was important, their guidance for the full year. Inflation and exposure to China, a really big challenge for that. A medical equipment maker currently down around 10%. Talking of China, more shockwaves to China's economy. China's deepening property bust is causing pain for the nation's 400 million strong middle class, upending the belief that real estate is a surefire way to build wealth. Meanwhile, a perfect storm of factors has propelled unemployment among 16 to 24-year-olds to a record 19.3%, more than twice the comparable rate in the US. David Lubin, head of emerging markets research at Citi, joins us now for the view on China and the broader EM space. David, thank you for coming to the studio.
Thank you.
How stimulative is the China policy response likely to be, given all of the challenges?
Well, as you implied, I mean, the property stimulus, which is usually an important source of stimulus policies for the Chinese authorities, doesn't seem to be in existence at the moment. I mean, if you look back at the three big stimulus packages that we've seen over the last 12 years, 2009, 2016, 2020, on each of those occasions, the stimulus fired on two engines, infrastructure and real estate. And for complicated reasons, the real estate engine just isn't firing at the moment. I suspect the reason has something to do with the growing role of ideology in the shaping of economic policy in China. One of the important mantras of the Xi era has been that houses are for living in and not for speculating on. And if you combine that with the common prosperity agenda that was articulated during the course of 2021, the idea that the Communist Party is beginning to feel that the growing income and wealth disparities in China may become a threat to its legitimacy, is requiring it to kind of respond to that income and wealth inequality problem. And since unaffordable housing is understood to be kind of part of the common prosperity problem, then stimulating real estate is not really part of their agenda at the moment. And they have this kind of what they describe as a cross-cyclical agenda to kind of withdraw or reduce the dependence of the Chinese economy on real estate.
I think that broader top line is often overly missed, that we've gone from pragmatic policy making to ideologically led policy making under the leadership of Xi Jinping. We're seeing that playing out across sectors and more broadly, of course, with COVID-0. So the implications then, as you say, you're suggesting that you're going to get a more muted fiscal response because of those constraints around funneling it through that ideological lens. What does that mean for the EM space and the broader global economy if you get less bang for your buck from the Chinese stimulus?
Yes, very good question. Of course, it's not just China that is a problem for other emerging economies. I mean, the fact is that the European economy is going imminently into recession, and there are very severe risks of a US recession in 2023. So the external demand environment facing emerging economies is really not very pleasant. But it's more than that, because of the way these recessions in the US and in Europe are sequenced. Because the European economy is going into recession quick, and because this is a kind of event-induced recession, particularly the result of the Russian invasion of Ukraine, the US economy is relatively strong. The US recession in 2023 will be a policy-induced recession rather than an event-induced recession. And because the sequencing, the European economy is going into recession first, and because the US is tightening policy that will result in a policy-induced recession, the result is that the US dollar is strengthening, US monetary conditions are relatively tight. That delivers for emerging economies the worst of both worlds, because not only are they facing a weak external demand environment, they can't export stuff, but also because of the tightening of US monetary conditions, capital flows to emerging economies are being threatened, and that's bad news for...
And that brings me into my question about King Dollar and the role that that's having, the pain that's being felt across the EM as a result of that two-decade high US dollar. Where is that pain most acute at this point?
A strong dollar is inconvenient for emerging economies for a bunch of reasons. One is that when the dollar strengthens, emerging economies lose creditworthiness. To the extent that an emerging economy has dollar-denominated liabilities, when the dollar strengthens, it becomes more expensive for countries to buy the dollars they need to service their debt. So creditworthiness is threatened. But one particular threat that I think is worth kind of bearing in mind at the moment has to do with inflation in emerging markets. Now, for most of the last 10 years, when you look at the relationship between currency depreciation and inflation, there's not much to write about. In other words, over the last 10 years, it takes a big increase in a country's exchange rate to create an inflation problem. But I suspect that that's changing now, that when you have a situation now, when inflation is already accelerating, when in that environment, as a result of a strong dollar, emerging market currencies are weakening, that is more likely to give a boost to emerging markets inflation today than
Turkey springs to mind. Sorry? Turkey springs to mind.
Well, Turkey's a unique case,
right.
but it's the same process as it worked, that a weaker exchange rate feeds through.
Let me very briefly, we're running out of time, but very briefly I want to get your views on the commodity complex across EM and those, the commodity importers versus the exporters. Can we expect that a Brazil is better placed than a Mexico, for example?
Not necessarily, because even when commodity, well, first of all, the problem is that, commodity prices are falling, and that falling commodity price is a reflection of growing recession fears and risk aversion. The combination of recession fears and risk aversion is going to be particularly unpleasant for all developing countries because they depend on external demand growth and risk appetite.
David Lubin, fascinating insights. Thank you very much. Head of EM research at Citi on the risks posed to the EM space and potentially less impact at least from any fiscal response coming out of China. Coming up, Diess is the end. See what we did there? VW Ousted CEO appointing the boss of Porsche as his successor. We'll get more on his abrupt exit, what led up to it, and the future for this automaker. That is next. This is Bloomberg.
On the product may read made in the USA, but the sign on the CEO's door often says made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Welcome back to the Open. Happy Monday. We are 42 minutes into the European trading day. You're seeing losses of 0.3% across European equities. When it comes to the banking sector, top of the list, up 0.6%, one of the 3 or 4 sectors that is just clinging on to gains in the session today. Talking of banking, Julius Baer's CEO says the worst is over for the Swiss wealth manager after a challenging first half. Philip Rickenbacher spoke to Bloomberg's Manus Cranny.
This was a resilient result under very difficult market circumstances. I think the first half of this year has been, as some said, the most exceptional circumstances in decades. I think we did feel that geopolitically, macroeconomically, and things have been moving fast. And we saw this on the net new money side with deleveraging, especially in Asia, until the interim management statement. Now we've seen a relatively fast inflow in the last 2 months. We've seen similar on the revenue side with clients being active in the market in the first few months, much less active in the last 2. And I think it's just very difficult to look at this from a point-in-time view. But I think overall the result we've done a strong and stable job.
Do you think the worst of that deleveraging is behind us? Are we swinging from pure fear to preparedness for a little bit of greed?
I think the worst is through, at least from what we've seen. And I don't think it was just fear, it was also caution, in line with the cautious stance that we took to the markets and to credit. And I think clients have preserved their firepower by deleveraging in the first few months of this year. And while it's a bit too early yet to see a full swing re-leverage, I think clients will look very clearly at opportunity in the second half to position them for 23 and beyond.
Are they positioning for inflation? Is it going to be a boost in mortgages? What are you telling the teams out there to push with clients as a defense for inflation and preparedness for the next shift?
I think inflation is going to stay. At least some of it, labor is going to get more expensive. The big question is, will we have a recession or not? I think current signals are no. There might still be a soft landing, but you never know. The percentages change fast. So I think clients need to prepare for different macroeconomic scenarios. If I look forward, I mean, where are the opportunities? Maybe on the credit side, looking at credit spreads. Long-term rates may peak now in the second half. Equities, there's no way around equities because they're real assets. Then maybe there's a revival on the hedge fund side, and maybe there's some liquidity in secondary market in private assets. So I think there's a few things to look at for investors.
It's interesting that we're in a new rate regime, whether it's jumbo rate hikes, 50 basis points from the ECB. Talk me through what this hiking regime will mean in terms of net interest income. You said it would be a boost. Scale it for me.
I think it is a boost, and we've seen it on the dollar side. We see it to some extent on the euro side. We've given the numbers in our update, so there's a meaningful tailwind to it. That's always a modeling part, and I think the interest rate income is one part of the equation. The other part of the equation is then client activity, and when it pushes too hard and pushes the market into recessionary territory, then obviously I think the losses you find on the transactional side may compensate some of those tailwinds.
Okay, Julius Baer, CEO Philip Rickenbacker there speaking to Bloomberg's Manus Cranny just a short time ago. Now, Volkswagen's dramatic move to oust its combative CEO was set in motion a week ago when his backing from the billionaire Porsche and Pirsch family began to crumble. After a number of key project failures combined with worker discontent, the family concluded he had to go. Let's bring in Bloomberg's Cardsar then, Craig Trudell, who's been following all the twists and turns of this fascinating corporate story for us. Why did ultimately Volkswagen make this move on Diess?
So I think we've been through many brushes that Diess had in terms of almost losing his job, and a lot of that had to do with that worker discontent that you just referred to. A lot of tension with the works councils in Germany.
And to be clear, they hold significant sway.
Absolutely. The unions, the state of Lower Saxony, obviously often sides with labor for the obvious reason of jobs. But this was a case where it wasn't just sort of throwing bombs that ticked off workers, but also the project failures, specifically software. So this is a case where Volkswagen over the last few years has had restart after restart in terms of how it's going to develop the software to sort of bring its cars up to what Teslas are capable of doing. They really just have not pulled that off, and we've started to learn over the last few weeks that several new models, including the Porsche Macan, have been pushed back as a result of software issues, and ultimately that really was sort of the straw that broke the camel's back here.
So it's actually delaying, these software issues are actually delaying the rollout of new models. When it comes to the new CEO then, Mr. Bloom, formerly of Porsche, what do we know about him, his ability to take on this role, and the challenges that he now confronts?
So Bloom, interestingly, is going to sort of be perceived. He's perceived at least as much more of a team player. He's more of a lifer at Volkswagen. I think that was one of the big challenges for Diess. Was he was brought in from the outside from BMW. That worked in his favor in the sense that it sort of gave Volkswagen a chance to portray a clean slate after Dieselgate, and he was seen as sort of the change agent that Volkswagen needed. I think they now have a guy who they sort of believe has a steadier hand, is going to better be able to navigate the various factions that one has to in leading this beast of a company that is Volkswagen. The question is sort of is a car guy going to be the solution for the software issues that we just alluded to. He's also going to keep the Porsche job in the midst of this very busy time where they're trying to take Porsche public. So, he's got a lot on his plate. I think that's one of the big concerns is, managing all of these various tasks in the midst of all this market turmoil and this attempt to take a really valuable asset public.
Okay, well, we're watching to see how Mr. Bloomer, then, the new CEO of VW, fares amid all of those challenges. As you say, fascinating corporate story. Thank you for bringing that to us. Craig Trudell, of course, Bloomberg's car czar. Now, coming up, London is in danger of becoming, just to quote, regional stock market, a regional stock market, unless it significantly ups its game. That is the warning from the person charged with sprucing up the UK's listing rules. More on that next. This is Bloomberg.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open. We are 51 minutes into the European trading day. This Monday, you're seeing losses of a little under 0.2%, pairing some of the heavier losses that we saw at the start of the session. There are investors trying to take advantage of the recent gains, but of course the concerns about recession risks over in the US. The S&P E-mini is pointing lower by 0.1%, but you have some more sectors here in Europe opening into the green now. Banks, telecoms, utilities pointing to some very modest upside, but broadly again, Euro off by 0.2%. Let's take a look at some of the other things to watch out for in the week ahead then. Later this morning, we will get the latest IFO business climate survey from Germany, of course, an important gauge of the strength or weakness of that economy around recession fears. Then this evening, the remaining two candidates for the leadership of the UK Conservative Party, Rishi Sunak and Liz Truss, well, they participate in a televised debate. We'll see if Sunak can move the needle. Tomorrow, we have a slew of earnings, including from Alphabet, GM, GE, and UPS. Plus, the IMF releases its World Economic Outlook update. And on Wednesday, of course, the big one, the Fed reveals its latest rate decision. We are expecting 75 basis points. Plus, we will have earnings from Meta and Samsung. Then on Thursday, it's the turn of Amazon and Apple to release their numbers. We'll also have the latest US GDP data. And on Friday, plenty of data from Europe, including CPI and GDP from the euro area. Inflation data, of course, will be front and centre given that more aggressive hike from the ECB last week, followed by second quarter earnings as well from US oil giants Exxon and Chevron. Let's go back to the UK then. London is in danger of becoming a mere, quote, regional stock market down the line unless it significantly raises its game. That is the warning from Mark Austin, the latest person charged with sprucing up the UK's listing rules and helping the city maintain its position as one of the world's leading financial centres. But speaking to Bloomberg last week, the LSE CEO, Julia Hoggett, was optimistic about the future of listings in London.
We have to work on today, but we also have to prepare for tomorrow and for the years to come and the structure of our markets, because people make long-term investments in interacting with our markets, and therefore we have to have long-term visions for what we do. And actually that long-term vision in the UK is coalescing in a way I haven't seen in a very long time. We've seen it with the creation of the Capital Markets Industry Task Force to pick up on the Hill and Khalifa reviews and Mark Austin's review to really work on how we continue to enhance the dynamism of the UK markets. That is happening, notwithstanding the fact that we have an interregnum right now, but that commitment I see as something that is cross-party, is totally focused in the UK, and there is greater consensus than I've seen in a long time.
Okay, joining us now is Bloomberg's Lizzie Burden for the latest on this story. What is the difference between this warning from Mark Austin and previous warnings that we've had about the fate of the UK, of London as a financial centre? Why should we be taking this warning more seriously than maybe some of the others?
Yeah, we've had years of doom-mongering, haven't we? But what's different about this from Mark Austin is that it's based on evidence. So he's saying companies that are considering listing in Europe over the US might choose cities like Amsterdam over London because of all that's already happened. So look at SoftBank dithering over whether to do its partial listing of Arm in London because of, it cites, the political instability here. Then you've got all the other flops like Deliveroo and Made. And then on top of that, just look at Nadine Zahawi, the new Chancellor, introducing the Financial Services Bill on Wednesday, but missing out the call-in powers that were widely expected, which would have given ministers the opportunity to challenge independently set financial regulations. Now, that is something that the UK could have embraced as part of its post-Brexit freedoms, but actually it's in political limbo because of, as Juliet said, the limbo that the UK is in because we've got a lame duck Prime Minister. So what's different now is that it's actually based on evidence.
Okay, so there's the evidence and, of course, the politics as well. We can't get away from the politics. We have that leadership contest. At least we have the debate, one of the debates happening later tonight, of course, between Liz Truss, who is currently leading the polls, and Rishi Sunak. Where do things stand, and is Rishi and Sunak able, do you think, to move the dial ultimately in this debate?
Well, tax cuts were what separated all the candidates at the beginning when it was a wider field. Now it's a race for who can burn the EU regulations the fastest, which is frustrating for Rishi Sunak, of course, because he voted for Brexit, whereas Liz Truss voted for Remain, and yet now she's seen as the true leaver because there's no one more zealous than a convert. But when we look at the economic debate, Liz Truss says that she wants to take on the blob of the Treasury, the Bank of England, the city academia, and yet Rishi Sunak is saying that, well, his allies are saying that he's competent in the Treasury. All of that just appeals to Liz Truss's arguments about the blob, doesn't it?
The blob of the Treasury. Lizzie Burden, thank you very much. Of course, looking ahead to that TV debate. Stay with us. That is it for the European Market Open Surveillance Early Edition. Up next, this is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
The second quarter was impacted by a lot of headwinds.
We're fully staffed, so we're flying about 115% of the capacity that we had pre-COVID.
Inflation is going to stay. At least some of it, labor is going to get more expensive. The big question is, will we have a recession or not?
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Here's what's coming up on today's programme. Kicking off in the red, European equities start the week risk off with energy stocks leading to declines as oil prices fall. It is, of course, Fed week. The FOMC gears up for another jumbo hike with inflation at a 40-year high. And earnings coming thick and fast. Big banks and big oil dominate the week with inflation, supply chains, and the energy crisis in focus. The economic data, the earnings, both competing for the attention of investors, of course, as we await for that decision from the Fed later this week. We have the IFO Business Confidence Index for the month of July, and it is falling. It is fallen once again. We're going to be speaking, by the way, to the head of IFO just in the next 20 minutes or so. The Confidence Index coming in at 88.6, so below the estimates of 90.1. So it's another drop in terms of the IFO Business Sentiment Index and that survey, that gauge on just the robustness, of course, of the German economy. German July IFO Current Assessment Index is 97.7. The estimates were 97.5. Again, we're going to unpack that with the president, with the head of the IFO Institute in the next 20 minutes or so, of course, around concerns that Europe is heading towards a recession, even as the ECB, of course, hiked by 50 basis points last week. We also heard from the Governing Council of the Bank of Latvia, Mr. Kazaks, earlier, about 40 minutes ago, saying that a larger hike would be appropriate as we look ahead to that September decision from the European Central Bank. Across your equities, you're currently seeing euro-dollar, by the way. You're down by 0.2% on the single currency. Of course, the concerns about the euro were flagged by Madame Lagarde, and indeed they were by Kazaks as well, saying that a weaker euro is not helpful. Across the stock space, then, the benchmark is currently down 0.2%. The context is that over the last month, you've seen gains of a little over 2% across European equities. But again, concerns about inflation and that recessionary risk. Technology, that sector currently down 0.4%. The Bloomberg Dollar Index is essentially range-bound. Bitcoin currently down by 3.3%, just a gauge, of course, of risk and that lower risk sentiment. And you do have, in terms of what's happening across the yield space, a bit of a mixed picture when it comes to US Treasuries versus some of the peripherals here in Europe. Let's change it on and see how things are shaping there up again geographically across this map. The politics of the UK, you have a debate between the two leading contenders to take over from Bojo, a televised debate later today. Currently down 0.3%. More of an impact, of course, is what's happening in basic resources and the energy complex when it comes to European equities today. The DAX is currently down about 0.5%. We're looking at the auto sector. VW is lower. The FTSE 100, the FTSE MIB, I should say, is range bound. Of course, we know about the political risk now in that country as they gear up for elections. The Spanish IBEX, though, posting gains currently of 0.2%. Over in France, losses of 0.2. Let's get back then to the central banking action then. Fed Chair Jerome Powell and his colleagues are expected to hike by 75 basis points this week and signal their intention to keep moving higher in the months ahead.
I fully support another 75 basis point increase. However, my base case for July depends on incoming data.
Certainly, the inflation report suggests that there's no reason to say that a smaller rate increase than we did last time, right? Because nothing moved in that direction.
I think they need to go 75 at the next meeting.
You're seeing the Fed move quite aggressively, and in my opinion, very appropriately to get on top of what's significant inflation building in the economy.
The key thing that the Fed worries about, and that we all worry about, is inflation expectations becoming unanchored.
No matter what, whether they go, 50s or 75s, they're still going to be in a situation where the effect on inflation is out into next year.
I think the Fed will have to hold here probably longer. The market's pricing in cuts in early 2023, and that feels a little premature to us.
They've got a tough job ahead of them, but they're using the tools they have, which is to basically raise rates and change the balance sheet.
All right, for more analysis now, we are joined by Guillaume Menuet, head of EMEA Investment Strategy at Economics at Citi Private Bank. Guillaume, good morning. Thank you for joining us. What is your assumption about the path of rate hikes from the Federal Reserve towards the end of this year and into 2023, particularly given the softer economic data that is now starting to percolate through the system?
We think it's going to be quite difficult for the Federal Reserve to continue hiking into 2023, mainly because there's already been quite a few rate hikes delivered, and maybe because the transmission of much tighter policy stance into the economy could be happening slightly faster than what has been the case previously. So after the summer and after the 75 basis points we are going to get this week, we think that by September onwards, the tone of the Fed might shift a little bit and become a little bit less hawkish, to sit on the amount of tightening that they've had and look at the inflation expectations and then the way the economy is behaving.
Well, that's interesting. Is that your assessment? Is your assessment you're not taking too seriously, weighing up the words from Jay Powell and others that they have this determination to get back down to 2%? Because if they start to pause when it comes to September of this year, that would suggest that 2% target is going to be some way off.
But it's all forecast conditional, of course. And if your inflation forecasts show a smaller overshoot than what your inflation target should be theoretically, then I think the central banks, if you remember, before the COVID crisis, most of them moved the framework slightly to allow for a slight overshooting of inflation. So the 2%, I think, is not absolute. The moment you have a significant disanchoring, that you talk about the 2%. But once you start to approach this 2% on an asymptotic basis, and you look at how much you've hiked already and how much above neutral you might be, I think that the rhetoric starts to moderate slightly. And suddenly you have central banks which are so obsessed about continuing to say, we're going to hike until we get to 2%. Suddenly the rhetoric shifts slightly to say, well, we've hiked quite a lot. The economy has softened quite a lot. How about we start to slow down a little bit and see what's happening next?
Okay, so from the Fed to the ECB then, and the question as to whether or not this TPI tool, the transmission tool, the anti-fragmentation tool, is going to give the ECB, Madame Lagarde, cover to go further on rates. Do you see another 50 basis points from the ECB in September?
I think it's a given. They could even perhaps go to 75 basis points if they thought that the window for interest rate hikes was closing in terms of time because of the acceleration of inflation risks to the upside until we. So if the likelihood of recession was increasing materially, and we've seen the PMIs last week already showing a sub-50 print on a composite basis for the euro area. You see the IFO survey this morning suggesting that all is not well, particularly in the euro's largest economy, Germany. So I think it's going to be sharp but short. And sharp needs at least 50, perhaps not 75. And by the time you get to the end of the year, the ECB will most likely be done.
Okay, the sharp and short scenario for the ECB. Guillaume Minuet, head of EMEA Investment Strategy and Economics at Citi Private Bank, stays with us. We'll get more of his calls on how to reshape your portfolio in this environment after the break. Coming up, risk-off mood. We discuss the events this week that investors are watching out for, including, of course, that Fed decision, a slew of earnings, and even more economic data. This is Bloomberg.
Crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The second quarter was impacted by a lot of headwinds. We had China lockdown, supply issues, and rising inflation. We have taken decisive action in terms of further improvements on the supply chain, as well as productivity and pricing. We see for the second half of the year a 6 to 9% growth.
That was the CEO of Philips, Frans van Houten, of course, speaking to us earlier about the headwinds the company faced in the second quarter. Inflation, of course, their exposure to China, to name but two. Guillaume Minuet, meanwhile, head of EMEA Investment Strategy and Economics at Citi Private Bank, is still with us. Guillaume, you've been adjusting allocations. You're calling for an adjustment to allocations. How are you repositioning in this environment, and what have the earnings so far told you about the direction of travel for these corporates?
The key, I think, message for the last few quarters was that you have to position portfolios for a significant slowdown in global economic activity, and therefore you have to increase significantly your exposure to quality. We've done this throughout the year through the dividend growers, in particular those very good quality companies which have got these very good track records of paying dividends to their investors, but also have the pricing power, the right products in the right markets. And that has been, I think, a very successful strategy so far. What we're seeing now is that because of the correction in oil prices, we've taken out the overweights that we had in terms of oil services in particular, but we're staying overweight commodities because we think that, unfortunately, Russia and Ukraine is nowhere to be solved. But we're starting to increase a little bit now on the quality side within the fixed income too. And investment-grade credits, in particular in the US, seem to be an attractive place to be. Because, as I said to you at the start, we think that the Fed is really going to be moderating its rate hiking cycle beyond the summer, early autumn. And the gap that you can see today in terms of yields is starting to get very interesting historically.
And on a sector-by-sector basis, Guillaume, you say that, okay, you're cautious, certainly, on European equities, but you say that pharma, food, and luxury within European equities remain and deserve to remain in any diversified portfolio.
Yes, because you're talking about sectors in which households will continue to spend a significant amount of money. These are the consumer staples, these are the must-have rather than the need-to-have. Discretionary, I think, is a little bit different. And I think the angle that we're taking from European luxury goods is that if we have this rebound in China, which we think is just a question of time, given the sort of policy impetus out there, these will do relatively well, especially at a time where you see that the euro is so much cheaper. So the domestic angle is in terms of pharma, in terms of food, and the sort of more international angle is luxury, because we think that those quality names across those sectors that we mentioned before should do well, both in terms of valuations, but also given where we are in the cycle.
I want to get your views, Guillaume, on technology. Of course, a massive week for the mega cap tech names. There's going to be divergence within this basket, you would assume. How are you looking at technology, and how much and where within that space are you finding opportunities at this point?
So I think the market will continue to differentiate very clearly between the bigger large caps, the mega caps in the tech sector, which have got these recurring revenues as licenses that they roll over and for which they can pretty much charge anything they want to captive customers, and the sort of smaller part of the sector, which might be dependent more on big investment projects that corporates might do in the IT space, which might be curtailed somewhat if the visibility is not there in terms of hiring or investment plans. So a fairly bifurcated market where really the top names should do relatively better. And if we think about the direction of long-term yields as well, and the correlation that used to be there, maybe the sell-off that we saw throughout the first few quarters of the year is probably over in terms of the bigger quality tech names in this world, which have got this built-in.
So just to be clear, and before we let you go, is this the appropriate moment then to be adding to mega cap tech?
I think that we're going to have the discussion, intense discussion in the next few months, but I think it's getting close to the point where we can see that value emerging here and long-term trends, which we think we want to be exposed to in terms of cybersecurity for the likes, which will have to be in portfolios on a long-term basis.
Okay, interesting. Thank you. Guillaume Menuet, Head of EMEA Investment Strategy and Economics at Citi Private Bank. We appreciate your time this morning, kicking things off for us this Monday morning. Let's get to the Bloomberg First Word News now with Leanne Gerrans. Leanne.
Tom, good morning. The US says a cruise missile strike on Odessa's port cast serious doubt over Russia's commitment to an accord it signed just hours earlier. The deal is intended to facilitate Ukrainian grain exports through the port on the Black Sea. Ukraine's president says his country has about $10 billion in grain waiting to be exported. Now, the chief of the World Health Organization has declared monkeypox an international emergency. The WHO director overruled a divided panel to issue the group's highest alert. The move paves the way for more international cooperation to stop the virus. Liz Truss and Rishi Sunak have both promised to toughen border controls as they battle to become the country's next leader of the Conservative Party and, of course, the next Prime Minister. Sunak says he will tighten the definition of what qualifies for asylum and introduce a cap on those numbers. Truss says she will fully implement the Rwanda policy and increase the UK border force by 20%. And Elon Musk has denied having an affair with Sergey Brin's wife. That's after the Wall Street Journal reported a liaison that led the Google co-founder to sell his investments in Musk's company. Musk has now tweeted that the Journal's report of an affair last December in Miami is not true and that he and Brin still remain friends. Brin filed for divorce from Nicole Shanahan back in January. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than in 120 countries. I'm Leanne Gerrans. This is Bloomberg. Tom.
Leanne, thank you. Okay, coming up, IFO Institute President Clemens Fuest on their latest German Business Climate Index. It was not good. That interview is next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Ken Griffin is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, German business confidence deteriorated to the worst level since the early months of the pandemic on growing concerns that record inflation and limited energy supplies from Russia will throw Europe's biggest economy into a recession. Joining us now to discuss the latest data is Clemens Fuest, the IFO Institute President. Clemens, we always appreciate your time coming on for us to break down what is happening within the German economy on the back of this kind of data. Where are we, do you think, in terms of those recession risks? How close is Europe's growth engine of the German economy to that recession now?
Well, the risk is definitely growing. I think there is a likelihood that the third and fourth quarter will be quite bad. Maybe the economy will stagnate, but it might also fall into a recession. And that's really driven by the concern about gas rationing, and it's driven by generally rising prices. So companies are really feeling this. A lot of companies have problems passing on the higher costs, in particular, of course, the higher energy costs.
So there's a problem around passing on those higher energy costs. And of course, we don't have much clarity in terms of Russia and its role in supplying that gas in the months ahead. What is the adjustment that's been made by companies? How successfully have they been able to adjust that those higher prices? And do we have any clarity on when those inflationary pressures may start to ease?
Well, I think there are first signs of easing inflationary pressures. Some commodity prices have come down a little bit also as a result of the cooling of the Chinese economy. Still, companies are reporting they have problems with the high prices and also with supply bottlenecks. At the same time, a lot of companies are trying, for instance, to replace gas by oil. A lot of heating systems are flexible, so they can be put on oil. That's more costly, but it's a possibility. Other companies are trying partly strange things, sometimes replace wood or wood-based materials, trying to burn that instead of gas. But there are wide areas of the economy where that's difficult, in particular in the chemical industry, where gas is needed for both heating and certain processes, production processes. So there are limits to this substitution.
What about the fiscal response from the German government? Is there anything that is being lined up by officials in Berlin to support this economy on the fiscal front?
Well, there is, but it's not easy to support the economy on the fiscal front because this crisis is coming from the supply side. So it's supply restrictions. So popping up demand is in a way counterproductive. What does come from the fiscal side is support for gas providers like Unilever, so preventing a collapse of gas providers. And what's also a possibility is that if companies need to shut down, they will get help to weather the storm. But it's very hard to support the economy in times where the slowdown is coming from the supply side.
Is the biggest drag going forward going to be gas or a hiking ECB?
It certainly is gas and high energy prices. So it's not just gas, it's oil, it's all types of energy, electric energy. The prices are rising, and that is a big problem for manufacturing. The hike of the ECB is in a way already priced in. So financing costs have increased, and that's felt in particular in construction, where we see rather negative data. A lot of construction projects are cancelled, really, and this is due to high prices, but also due to high interest rates, high financing costs.
Okay. Clemens Fuß, always fascinating. Thank you. Appreciate your time. President of the IFO Institute on that weakening index. Coming up, this is the end. Yes, VW ousting its CEO. We'll get the latest on that story. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Kicking off in the red, European equities start the week risk off with energy stocks leading declines as oil prices fall. It is Fed week. The FOMC gears up for another jumbo hike with inflation at a 40-year high and earnings come thick and fast. Big banks and big oil dominate the week with inflation, supply chains and the energy crisis in focus. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Let's check in on your markets then. You are seeing a moderation of the heavier losses we saw at the start of the session around an hour and a half ago, just down about 0.2% across the benchmark European equities. Futures stateside range bound. The Nasdaq futures lower by 0.1%, higher by 0.1%, I should say. Across your sectors here in Europe, yes, leading the losses is energy, currently down 1.3%. Oil is lower. Banks, though, at the top of the list in the green, gaining 1.2%. Let's get to what's happening in the auto sector then. The auto sector, by the way, is also off by about 0.4%. There's the corporate story. Volkswagen abruptly ousting its CEO, Herbert Diess, on Friday, appointing the boss of Porsche as his successor. The move ends Diess's 4-year tenure at the helm of the automaker. We had led its massive electric car push. For more, we are joined by our auto star, Craig Trudell. Craig, why did VW make this move? Didn't they recently re-sign the contract with Diess? What was behind this?
They did, and he's been through so many brushes with kind of votes on his future with the company. It looks like he was going to emerge unscathed. Ultimately, it was not just the frequent clashes that he's had with labor leaders that really sort of led the Porsche and PSA families to have to sort of come to his defense. It was software, interestingly enough. So along with that announcement of his contract being extended, he took over the Cariad software unit. That unit has been really, frankly, just a mess, and there are multiple models that are being pushed back because of concerns about software development. It's really, proved to be challenging for VW to take these disparate units internally, put it, harmoniously run that organization and not set back schedules for new model launches, and that ultimately proved to be his undoing.
And those model launches have been set back in some cases as a result of this. So that's the software component. What about the shift to EVs, though, and the labor component? Should we take from this the friction he's had with the labor? Do we take from that and learn from that maybe the shift to EVs is going to be held up as a result of that?
Well, Oliver Blume is going to have some real challenges to confront because I think if any signal that Volkswagen is going to pull back at all on its electric car ambitions is not going to be taken well by the market. Of course, Porsche has been. You've
got to continue that shift whilst keeping the workers happy because it does involve for many companies laying off.
And that's going to be a tightrope to have to walk, right? Because you have even Ford in the last few weeks talking about investing in plants in Spain and yet bringing employment down in that factory, and that gives you an indication of just how much labor is at risk in the sense that you're going from a combustion engine that has so many moving parts, so many components, to a battery that is much simpler to make, much simpler to assemble. You need less labor for that, and so there's going to be this need to continue this momentum with electric. Porsche has been a success story in that respect, but he's going to have to keep that going for the broader group and find a way to do that potentially while reorganizing the company and bringing some job losses with it.
What else do we know about Bloomer, the man himself, and his past history, his resume, and again, some of those urgent tasks that he's going to have to address beyond the questions of software and that shift?
Volkswagen has really emphasized his, sort of team player mentality. He's been with the company a long time. I think that was one of the challenges that Diess had, was he was an outsider, right? He was brought in from BMW. He was, sort of put forward as this is the guy who's going to lead us out of the Dieselgate mess. He put the company on the right track in terms of electrification and had, a really strong vision, and that resonated with the market, at least for a period. I think ultimately it was just the execution that was the challenge. And so the bet here is that this guy who knows how to navigate VW, which is no easy task, is going to be able to do that and have some better success in terms of executing the course that Diess has set them on.
Okay, very interesting corporate story. We'll, of course, be following what happens with Bloomer and the success or not that he has. Thank you, of course, to Bloomberg's Carter, Craig Trudell. VW, by the way, currently trading down by 3.6%. To another big corporate, the importance of wealth management. Julius Baer profits slumped in the first half of 2022. That's as wild market swings spooked clients and eroded assets in the firm overseas. The firm overseas for the rich, of course. The Swiss private bank's assets under management fell 11%, reflecting market declines and a 1.1 billion franc in net redemptions. For more on this, our anchor Manus Cranny, who interviewed the CEO of Julius Baer earlier, knows this story so much better than anyone else. Manus, what for you was the key takeaway then?
That perhaps the deleveraging that was the hallmark of the first 6 months of the year, Tom, could be coming towards a basing out. And I think that's reflective in terms of where did you see the deleveraging? Well, that was in Asia. Where did you see the outflows? Again, a very Asia-centric private wealth business here by Julius Baer. I caught up with Philip Rickenbacker, the CEO. The market was very initially unconvinced by the headlines. And then we talked about the turn and is the worst past. Let's take a listen.
Inflation is going to stay. At least some of it, labor is going to get more expensive. The big question is, will we have a recession or not? I think current signals are no. There might still be a soft landing, but you never know. The percentages change fast. So I think clients need to prepare for different macroeconomic scenarios.
And that risk of recession is what drove the deleveraging, the hiding in cash. And we chatted about whether it's time, a bit like the Bank of America note, Tom, which is, are we pivoting from deep fear and take a contrarian position right now and re-leverage? He said they stored in cash, they deleveraged to protect themselves, to give themselves firepower. But it's been really, really quick. The turnaround in inflows has been quick and rapid in the past month and a half. And that lays the groundwork for, you got it, more business and higher ticket writing at the wealth management business.
So maybe a more solid groundwork then for that business going forward in the weeks and months ahead. A very different story, though, around UBS and Credit Suisse, Manus. What are you going to be looking at?
Completely. So the UBS story is very much around what pain did they take on the investment bank scenario. You saw it in the US in terms of deals and in terms of flow. So that pressure on the investment bank. What I will be keen to get a handle on with Ralph Hamers is, how did your outflows go in the second quarter? Is the deleveraging past? And I think it will be much more material because it's just the size of UBS is so much more of a quantum in terms of whether we are at the nadir of deleveraging and de-risking. So we'll catch up with Ralph on that. I think then when you get down Bahnhofstrasse and you get into Credit Suisse, you're in a completely different scenario. A CEO fighting to remain, a CEO fighting for institutional backing, a CEO that may have to do job cuts in Asia to make up for some of the deleveraging. So really a triptych of banks with three very, very different stories ongoing. Tom, I think the question now is whether you believe it's a moment for everybody to take a contrarian view and to retake some risk. I'm being outshone for once in my career by a very elegant young lady here, screaming down the banks of the Zurich River.
Screaming down, but listen, if you weren't interested in Swiss banking before, you certainly should be now, particularly Manus's insights and that beautiful backdrop. We're looking at those Other stories, of course, riveted. Thank you, Manus, as ever. Of course, our Daybreak Europe anchor in Zurich. And he's got plenty more from Manus in the days ahead. Coming up, we're going to speak to the governor of the Bank of Italy, Ignazio Visco. That interview is next. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, Italy has been at the centre of attention in Europe, of course, in the last week. An election is set for September 25th to usher in a new administration after the collapse of the Draghi government. Current polling suggests a right-wing coalition has a strong shot at ruling Italy after the elections. All of this, of course, coming as the ECB hiked 50 basis points and, of course, unveiled details around the TPI, that is the transmission protection, of course, tool, or the anti-fragmentation tool. For all of these topics, who better then to speak to the governor of the Bank of Italy, Ignazio Visco. Governor, thank you very much for joining us. And on the question of the European Central Bank, we heard from one of your colleagues, in fact, from the Bank of Latvia, suggesting that another larger rate hike in September is appropriate. Would you align with the view that maybe another 50 basis points would be appropriate in September? Or has the front loading that we saw of last week given the ECB the opportunity to take a more moderate approach?
Well, obviously, we have decided to take decisions meeting after meeting. So there is no way now to say whether it will be appropriate 50, 25, or whatever. What we have decided was to front load an increase in interest rate that is basically a normalization. So we ended out from the negative interest rates, and we will see, depending on data, how to go on. But clearly, this does not mean that we are not going to proceed in a gradual way. Graduality means moving step by step, not being very slow. And we are moving step by step simply because the inflation rate turned out higher than it was projected for a number of reasons. Interest rates, therefore, in real terms, were lower. And I think that we simply did a front loading of what had to be done. Markets have understood very well. There is no particular reaction. It is no time now really to ask for higher interest rates than we had up to now foreseen. Thank you.
Governor, how difficult was it to agree on that 50 basis points amongst the members last week?
It was not difficult. There was a long discussion, obviously. We have considered, as usual, all the elements for a decision. We had said in June in Amsterdam that we intended to raise by 25 basis points our official rates in July, and then actually inflation persistently was maintained at a higher level than it was expected, not only by us, by markets, by futures and so on. And the reason is simply linked to the protraction of these incredible war in Ukraine, and this implies that the energy prices have been maintained much higher than expected. As a matter of fact, the gas prices increased up to 150 euros per megawatt hour, which means basically almost double than what they were in the spring, and extremely more than they were last year. So in this sense, it was simply a way to, as I said, front load our normalization path.
Okay, the importance of front loading, and of course you stressed the importance of graduality as well, and taking it meeting by meeting. I just wonder, Governor, if we're able to get any clarity, given the data you're looking at now, as to where you see ultimately rates going, and when you expect rates to peak, and at what level?
When I expect what? I don't understand. What should I expect?
I wanted to get your views on when you expect rates to peak, when you expect them to get to the highest point they can get to, and on what kind of level you might be looking at this point.
No, I don't. So far, the conditions are such that both inflation expectations, wage prices, they are doing more or less in relatively positive way, reacting to this increase in energy prices, in inflation and so on. Obviously, they may increase, and this is the reason why we normalize and we try to take care of the what we call second round effects by avoiding that there is an increase in demand. But actually now we are in a very different situation still with respect to other areas of the world. There is no major demand pressure yet, and the path of interest rates rises, of normalization, is going to somehow counter the risks. I don't see it really getting out of our hands. It seems to me that we are proceeding as expected, and obviously the TPI is an instrument now that will help us to avoid excessive volatility, disorderly movements in markets following our decisions, and somehow misunderstanding what really the risks are.
And on the TPI, Governor, do you see any chance that Italy will indeed qualify for that kind of instrument?
Well, Italy, as any other country, TPI is an instrument that basically is designed not to protect a single country, but really to maintain a smooth transmission of monetary policy, which is meant to achieve price stability. Now, this is something that has to do with the incompleteness of our monetary union. We don't have a well-functioning banking union. We have delays in the capital market union, not to say the fiscal clearly union, or steps towards that, which are crucial for monetary policy to have a single counterpart in the macroeconomic framework. So in this sense, we are looking to a number of issues. The Governing Council will be autonomous in deciding when and how to intervene. the conditions are standard conditions. That is, we have basically the maintenance of agreement with the EU fiscal framework, the sustainability of fiscal conditions, the macroeconomic imbalances not to be there, and especially I also would say the permanence of sound and sustainable macroeconomic policies, which is something different from the developments of political systems. So any political change will come with different or possible maintaining the main policy decisions, objectives, frameworks, and so on. And the markets, as well as us, will have to value how much these will imply that the conditions are sustainable, and therefore any disorderly movements in markets will be unwarranted. The word unwarranted is really crucial.
Okay, unwarranted market moves is what we're looking at. And so far, the reaction from Italian debt, BTPs, is, as you said, relatively muted. But on the question of politics then, and of course, political risk in Italy back on the front pages last week, if we do get to a point where BTPs, where Italian debt yields are blowing out, whether it's 250 versus the Bunds or 300, and it is down to political risk, the suggestion is that the TPI tool would then not apply. What would happen in that context if a blowout of a spreads, but that is tied to political risk? What would then be the reaction to that?
I understand. The issue here is whether our policy changes and decisions have been interpreted by the market in making conditions more difficult for the Italian debt and so on. This is not so. At the end, there has been some turmoil, and I still think that the current spread with respect to German bonds is somehow much higher than what would be justified by the macroeconomic fundamentals of the country. But this is still something that has to do with the uncertainty the market sees in terms of policies. We have to really look at what will be at the end the policy framework that will take place in the country. I don't see particular risk up to now. I think that the most important thing for Italy is to maintain the ability to return to a higher rate of growth than the one we had experienced in the last 15 years or so, or 20 perhaps. And the issue here is very simple. Much of the rise in the debt-to-income ratios, to GDP ratios, is due not to fiscal inability to be prudent or careful, even if I'm sure that much better could have been done in terms of distinguishing between current expenditures and expenditures for public investment. But at the end, it will be extremely important the increase in GDP. If we had a GDP increase in the last 15 years as the one it was after the monetary union until the financial crisis, it would have been much below 100% today, the debt GDP ratio. So, I mean, this is really the crucial, what the policies will be, but the objectives are very clear, and the political system, I think, will have to follow those objectives as the way set by the Draghi government.
Governor, we are very fortunate to have your insights and to have you on today. We do appreciate it. Thank you very much indeed. Of course, Ignazio Visco, the governor of the Bank of Italy. Coming up, travel chaos continues to plague airlines. We will focus on Ryanair next. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound.
Okay.
And that crack is a sonic boom.
Yeah.
I think the way they got a date was to impress the females by making loud booms.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
We're fully staffed, so we're flying about 115% of the capacity that we had pre-COVID. And the plan is to grow from 149 million customers pre-COVID to 165 million in the current financial year, which is up from 97 million last year.
That was the CFO of Ryanair, Neil Sorahan, speaking to us earlier. We are now joined by Sid Phillip, our European Airlines and Autos reporter, on the back of a decent set of numbers from Ryanair. How do they manage to navigate the summer when everyone else failed to get their staffing in place?
So Ryanair is unique among most European carriers in that during the height of the pandemic, when airlines, including British Airways, were laying off as many as 10,000 workers, and EasyJet was cutting 2,000 workers, Ryanair didn't keep workers on. It just it kept them on. It kept them on lower pay. It reached negotiating agreements with unions to cut pay, and that helped them keep staff on. And so when the demand came back, they were able to ramp up quickly and sort of scale up there.
Okay, success story for Ryanair. Thank you, Sid Phillips, of course, our European Airlines and Autos reporter. Plenty more coming up. Stay with us. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done, uses a small sample number, and most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
I think what we're seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
We have heard from a lot of companies that they're thinking the following environment is going to be more challenging.
We're at an inflection point, and markets are essentially trying to figure out if they need to follow the nominal growth or the real growth.
We're going to see much lower growth in the second half of this year.
A mild recession is certainly in the offing.
We're seeing signs that global economic growth is decelerating at a pretty rapid clip here.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Central banks signal that more large rate hikes are on the way. The Fed is set for another big increase this week. And an ECB policymaker says that stronger hikes may not be over after last week's move. European bank earnings season is underway. Julius Baer sees its profits fall. Meanwhile, Credit Suisse reportedly is considering job cuts. And the WHO sounds the alarm on the spread of monkeypox. We'll talk with the organization's senior emergency officer. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines over in New York. Kaylee, it is Monday once again. A lot of European earnings to talk about this week and a Fed decision crucially in the middle.
Yeah, it's going to be a busy one, Anna, especially with the mega cap tech stocks reporting here in the U.S. throughout the week as well. So we're awaiting those results. But of course, to start the week this week, recession fears are still very much front and center, and that weighed on risk sentiment in Asia overnight. A broad down day for most of the major benchmarks in the region. The MSCI Asia Pacific Index as a whole falling by about 0.5%. One group of stocks that bucked that trend, though, was actually Chinese property stocks. This is after a report that the China State Council is looking to approve a fund to help support some of those developers. So if approved, it would be one of the most direct ways yet that they are intervening in the property market, which remains in turmoil. So those property stocks up about 1.7%, and you saw a little bit of lift to high yield bonds in China as well. Speaking of bonds in China, we have to talk about sovereign debt as well, because at one point earlier in the session, the Chinese 10-year yield was actually above that of the U.S. 10-year Treasury yield, right now sitting at 278. And I think we're seeing a little bit of selling pressure coming into Treasuries, Matt, so that story changing, but still one to watch as we've seen that yield here in the U.S. coming down substantially in recent days. And finally, in foreign exchange, your Japanese yen is the big underperformer in Asia. It's weaker against the dollar this morning, trading at 136.40, Matt.
It looks so strong at 136 nonetheless. I'm taking a look at S&P futures that are actually rising this morning. So there's a lot of talk about recession fear, especially over the weekend, especially ahead of the Fed meeting on Wednesday when we're expecting a 75 basis point hike. Nonetheless, we have futures in positive territory, and investors are letting go of 10-year paper. Right now, floating up about 5.5 basis points, but only to 280. Remember, we saw that huge drop in this rate last week. I think in 2 sessions, we saw 27 basis points fall away from the 10-year yield. NYMEX crude right now down 17 cents a barrel to 94.53, 94.49. So now holding at a relatively low level, and Bitcoin also falling 3%. This, I'm going to say, measured from yesterday's price, although it could be 5 p.m. on Friday. In any case, it's still at 22,000, so still looking pretty strong from the 20,000 levels that we saw for so long. Anna, what do you see in terms of European stocks?
We're a little bit directionless, Matt, in all honesty, here on the European stocks picture. It's such a busy week ahead, perhaps waiting for a few clues, certainly from the Fed and also from the European earnings. And as Kaylee said, the big tech picture over in the United States. So things look pretty muted right now. We started in negative territory, factoring in some of the weakness that we saw in the US on Friday around tech and telecoms. All of that was playing weakly in the US. And so Europe had to play a bit of catch up with that. But we've since recovered our poise, and we're now pretty flat across European equity markets. Let's have a look at where we are seeing some of the bigger movement, and we have some movement in the energy sector to talk about. Energy prices are a little bit weaker, and we do see that the energy stocks here in Europe are down by 0.8%. We've got a lot of corporates reporting this week, including some of the energy names. Interesting, you were talking about the sort of dance that we've seen on treasuries with those yields coming down substantially over recent days, as last week's weak data on both sides of the Atlantic sent people into the perceived safety of those government debt markets. That brought those yields down. Well, today we're seeing a little bit of a reversal in that, and that's what we see in the German 2-year yield. Even if the data continues to be weak, we've certainly had some warnings about recession once again over in Germany. Philips, the share price of this medical devices business, down by 10.4%. And just as a reminder, we're still dealing with supply chain issues very much attached to China, and particular to COVID policy. We heard from the CEO of that business calling for a change there. And I put in Eutelsat because this is a fascinating story. Europe has for a long time talked about trying to create a rival to Elon Musk's activities in space. And of course, Europe is far behind on this front. But this is a French-listed business trying to acquire a UK-based rival and trying to scale up on that front. But there are so many government stakes in both of those businesses that there are a lot of execution risks, let's say. Kaylee.
All right, Anna, well, we will continue to keep an eye on that story. And as we've been discussing, there is a lot to keep an eye on this week. So let's take a look at what is ahead. As I mentioned, big tech earnings will continue. We got Alphabet, Apple, and Amazon reporting, as well as the likes of Meta. So we'll see how those advertising headwinds are affecting some of those bigger cap players. Then European bank earnings will be taking place as well. UBS, Credit Suisse, and Deutsche Bank all will be reporting throughout the course of the week. Of course, it's the Fed rate decision on Wednesday. Will they move another 75 basis points? Then on Thursday, we'll get second quarter GDP data from the U.S., and we'll be getting Europe data as well. CPI on Thursday and GDP on Friday, Matt.
So a lot of data coming out, a lot of exciting earnings coming out as well. Concern about the economy has really taken up the weekend nonetheless. Treasury Secretary Janet Yellen expressed confidence in the Fed's fight against inflation. She spoke in an interview on NBC's Meet the Press yesterday.
We're likely to see some slowing of job creation, but I don't think that that's a recession. A recession is broad-based weakness in the economy. We're not seeing that now.
Fed Chair Jerome Powell and his colleagues are expected to boost rates 75 basis points again this week and signal their intent to move higher in the months ahead. Joining us now for more is Michelle Jamrisco, our senior Asia economy reporter. Michelle, how are Fed officials doing in trying to convince everybody that they can achieve a soft landing?
Well, not so good, Matt. I mean, I think that divergence between the officials on one side and the economists and market participants on the other is a growing one, and it's unsettling now. You did hear from Treasury Secretary Janet Yellen yesterday, kind of echoing what Jerome Powell has said, that they can achieve that soft landing, that they can find a way to avert recession. Of course, we heard 2 weeks ago from Fed Governor Waller that he said it was inconceivable that the economy would go into recession at this point with 3.6% 8% unemployment. So they're certainly making their case, but yes, it's growing more and more skepticism in the market and among economists that they can achieve that. It's a very narrow path to make sure that that job slowing doesn't become a recession. And in two ways, it's quite complicated. One, the Fed is still dealing with some supply side inflation, which of course is less controllable and more unpredictable, in this case stemming from the war in Ukraine. And at the same time, monetary policy works with a lag, as we're reminded. So, there's kind of a race to win that inflation fight before unemployment ticks up to a level that they'll have to kind of ease again. So it's very unsettling at this point, and not everyone is convinced.
Well, and of course, that's the picture in the U.S., Michelle. And in Europe, we have seen a string of really not great economic data points. Yet at the same time, the ECB Governor Martin Kazak's out speaking today, saying that the central bank could keep adding big hikes even after last week's 50 basis point move. What was your main takeaway from his comments earlier this morning?
Yeah, it was interesting, Kaylee. I mean, we were talking last week about whether forward guidance is dead, of course, with the ECB moving with 50 basis points after really signaling hard, especially from the top, and Christine Lagarde saying it would be 25 or signaling it would be 25. So now we're hearing that this isn't over, that maybe they didn't get out of their system with this shock hike, that perhaps they'll have, equivalent or some big sort of hike in September as well. I think, to me, it just says expect the unexpected. We're in uncertain times, given especially the uncertainty around the war in Ukraine again and its impact in Europe. A lot of what Kazak's was saying, and we know him to be among the most hawkish of the ECB officials on the governing council. But what he was saying seemed entirely reasonable. He said they're open to discussions. He said they're not just going to follow the Fed. He said there is significant downside risks. All things that you would expect central bankers to say today. But the bar is low right now for information. So even getting this idea that they could go again with a big hike is something to be noted today.
Yeah, and thank you very much, Michelle. Michelle Jambrisco there with analysis of the US and European economies. And one of the headwinds hanging over the European economy is, of course, gas supply from Russia. With that in mind, worth noting that the Kremlin has said this morning Russia is not interested in cutting off gas to Europe. Russia says it will ship as much gas as is technically possible via Nord Stream 1. We will see what actually comes to pass through the fall, the autumn, and into the winter. Now, Julius Baer's profits slumped in the first half of the year as volatile markets spooked clients and eroded assets the firm oversees for the rich. The CEO of the Swiss bank explained this profit slump to Bloomberg's Manus Cranny in Zurich.
This was a resilient result under very difficult market circumstances. I think the first half of this year has been, as some said, the most exceptional circumstances in decades. I think we did feel that geopolitically, macroeconomically. I think the worst is through, at least from what we've seen. And I don't think it was just fear, it was also caution.
Bloomberg's Manus Cranny joins us now from Zurich. He said then that the worst might be over, Manus. That was the positives, but there were some negatives as well.
Look, quite a bullish call, I thought, from Rickenbacker when I sat down with him a little bit earlier this morning. The question as we go into both Julius Baer, UBS and Credit Suisse is whether the deleveraging, de-risking and pivot to cash has really passed. His take was clients really hid. That fear that gripped the clients in the first half of the year may just abate ever so slightly. And that, I think, is the issue as to whether clients re-engage, reload, and refuel for risk on the upside. It's the Bank of America note sentiment, isn't it? Which is buy now. In other words, be a contrarian. But he quite liked credit. He said you can't avoid equities. And indeed, I thought he was trying to sell a bullish story on the back of lower fee income. And yes, new money came in, but the analysts are saying on the call here that that's just not enough in May and June to turn the story around. Anna.
Manus, apparently there's some mulling going on in Zurich with regards to job cuts. Credit Suisse looking to cut costs. What do we know?
Well, Credit Suisse is a very different story, structurally different. Yes, both Julius Baer and Credit Suisse both have massive exposure to Asia. But you have a CEO of Credit Suisse who is under huge pressure from the board, from shareholders. Gottstein has got to show. He's got to show that he's in command, show that he's in control. And that may well mean some aggressive pivot to cost cuts and job losses at Credit Suisse to rein in the costs and display, I am the CEO, I am here for longer than a long summer.
All right, Bloomberg's Manus Craney reporting from Zurich. Thank you so much. Let's turn to Washington now. President Biden's doctor says there are encouraging signs that he is overcoming the coronavirus. The White House physician noted in a daily update that the president's symptoms continue to improve significantly. He's being treated with Pfizer's drug Paxlovid. Meanwhile, the World Health Organization's head has declared the monkeypox outbreak a public health emergency of international concern. The virus has spread to about 16,000 people in more than 70 countries in just a few months. Let's get to Anne-Marie Horder, and Bloomberg Washington correspondent, for the latest on the White House response. Anne-Marie?
Well, the big question coming off the heels of this declaration from the WHO over the weekend, of course, is whether or not the U.S. would itself declare monkeypox an emergency. And the White House COVID coordinator, Ashish Jha, was asked about this on Friday, and he said that it was being weighed. He was asked about it again on the Sunday shows, and there was no new news to bring in terms of an emergency. They do think they can contain it. Right now, the U.S. is able to have vaccinations of about 300,000. They're able to test 80,000 people a week. And from Ashish Jha, as well as Anthony Fauci, it does seem like they're going to be ramping it up. The big question, though, would be whether or not they declare an emergency. And Dr. Jha had said the point of declaring an emergency is whether or not that would actually give us more tools, what we could do with that emergency to implicate change. But right now, it is something that they're just weighing at the moment. So no emergency yet in the United States. If it were to come, it would be declared by the U.S. Health and Human Services.
Anne-Marie, thanks very much. Bloomberg's Anne-Marie Horder reporting from Washington. Later this hour, we'll hear from Dr. Catherine Smallwood, Senior Emergency Officer at the World Health Organization, get the latest on monkeypox. Now, Volkswagen's dramatic move to oust its CEO was set in motion a week ago when his backing from the billionaire Porsche and Piech family began to crumble. Following key project failures and worker discontent, the family concluded he had to go. Craig Trudell joins us once again, global car czar, on the thinking behind the VW move. This really surprised the markets, but it was after the markets closed on Friday, European time, Craig. So today is the first time that European stocks have had a chance to react to this, and is quite a negative one. What do we know about why he had to go? This guy was in charge of the big electric push.
Yeah, and I think he got a lot of credit for really, being aggressive in taking a company that was just a few years removed from the Dieselgate scandal when he took over, and putting it on this path of having the biggest, broadest electric vehicle offering. I think that the challenge for Volkswagen really has been not just switching over powertrain, but really sort of modernizing its cars and sort of, going punch for punch with Tesla on the software aspect. You still have a situation where you're not, getting over-the-air updates to your car the way you get with your iPhone or with your Tesla, and that's something that Volkswagen has tried to replicate and really struggled to.
And of course, the big challenge for Volkswagen is governance. They have this albatross of workers, boards, and government stakeholders that are weighing in on every decision, so the CEO can't really operate freely, as we have seen. What is the new CEO going to do? Oliver Blume, he's already busy enough at Porsche, right? And they're preparing to IPO. You'd think investors would want an independent man in charge, but he's going to have a lot more to do.
Yeah, you nailed it on the head, Matt. I mean, that is one of the big sort of, common threads in the way the market is reacting to this news. It's, this idea that Blume is not only taking on this massive job and having to answer to all those various stakeholders that you referred to, he's also keeping the Porsche job and doing that while they're trying to take Porsche public, is only sort of adding to the governance concerns that you raise. And Porsche's, sort of overlap in ownership and the shareholdings of these companies. It's a bit of a mess for shareholders to sort of untangle and get comfortable with in terms of buying shares in Porsche. So that is, likely why, contributing to why you're seeing, the stock trading down this morning.
All right, Bloomberg's Craig Trudell, thank you so much. Now, speaking of stocks turning down, let's take a look at some stocks moving in pre-market trading here in the U.S. because one of the biggest underperformers is Moderna. This may be due to news over the weekend that the U.S. is putting COVID booster shots, additional ones for those under 50, on hold. That, according to the Washington Post. Moderna down about 3.3%. Also moving lower, a lot of cryptocurrency-tied stocks because we are seeing Bitcoin and other crypto prices under pressure today. Coinbase, the exchange, is one of them, down about 2%. percentage points. And finally, I just wanted to get a check on Snap as well, because the price action on Friday was brutal. The stock down 39% after disappointing revenue thanks to the slowdown in advertising online. Interestingly, though, the stock is up about 0.4%, so maybe just the smallest amount of dip buying coming in. But of course, this is now a stock down almost 80% year to date, Anna.
Yeah, don't call it a comeback, perhaps. Don't call it a bounce back then, Kaylee. Coming up, we will talk about the markets with Mark Anderson, UBS co-head of Global Asset Allocation. We'll talk about the Fed, talk about the earnings stories we've seen so far. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both radio and television, and we're looking ahead to Wednesday's Fed meeting. Are there still any investors out there betting on a 100 basis point hike? Cue chart. Let's bring in Tatiana Day right now to talk about the possibilities of that, as well as broader market implications this week. Tatiana, thanks for coming in early again with us. What do you think about the possibility of not just 75, but even 100 full basis points?
Yeah, well, I think such a historic move is somewhat unlikely now, just because it hasn't been telegraphed as well. But as we know from last time, the Fed only gave us a few days worth of notice, so perhaps it's not yet too late. But broadly, they have the Fed speakers have pushed back on this idea and are still expected to go 75 basis points. But I think broadly markets are now not only pushing back on 100 basis points, they're pushing back on even more. If you look year to year into the year end, they're expecting the Fed to stop hiking in December and start cutting rates here in February, just given that the economic data has worsened here. And I just worry it's a little bit premature for that, for us to have that conviction yet.
Well, the idea being that the economy is going to slow down enough that it causes the Fed to blink to a certain extent. And you're seeing the fears around a slowdown reflected in the equity market, because even though, yes, we've been rallying, it's the more defensive areas.
Yes, that happened on Friday, which represents sort of a shift from what we've seen this month so far. So on Friday, after those ugly PMIs, we've seen investors sort of pile into your classic defensive like utilities, consumer staples, real estate. But that represents a shift from what has been traded during the month of July. If we look at this rebound, it has largely been a risk on. If you look across factors, high beta stocks have actually outperformed outperformed, and that's not only your tech names, but also your travel, leisure, and other consumer discretionary, as well as your biotech, which really suggests some sort of a risk appetite there. Also, it doesn't really rhyme with a recession story, but at the same time, there's this idea that if we get a recession, it's going to be shallow, so it won't hurt stocks, much more than it has. So therefore, it's a good time to buy stocks.
Tatiana, thank you very much. Tatiana Darier from Bloomberg Markets Live. And for more market analysis, check out the Markets Live blog. MLIV Go is the function to use on your terminal. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Now, keeping you up to date with news from around the world, here's the first word. The U.S. says that a Russian cruise missile strike on the port of Odessa cast doubt on Moscow's commitment to the agreement on Ukrainian grain exports. The deal for safe shipment corridors was signed after months of talks. Russia said the missile attack targeted Ukrainian military infrastructure. And Elon Musk is denying he had an affair with Sergey Brin's wife. According to the Wall Street Journal, the alleged affair took place in December, which led Brin, the co-founder of Google, to sell his investments in Musk's companies. Musk says the story is untrue and he is still friends with Brin. Brin filed divorce from his wife in January. Coming up, we'll get back to the markets and have a conversation with Mark Anderson, UBS co-head of Global Asset Allocation. This is Bloomberg.
but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Central banks signal that more large rate hikes are on the way. The Fed is set for another big increase this week. And an ECB policymaker says that stronger hikes may not be over after last week's move. European bank earnings season is underway. Julius Baer sees its profit fall. Meanwhile, Credit Suisse reportedly is considering job cuts. And the WHO sounds the alarm on the spread of monkeypox. We will talk to the organisation's senior emergency officer. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. Matt, no doubt the Fed will dominate, but also big tech earnings and plenty of European corporates reporting this week as well, including the European banks.
Yes, and General Motors, I remind you, in about 24 hours from now. Nonetheless, it does look like we're still seeing gains on futures, so maybe the market is positive about those earnings or those data points or the Fed meeting on Wednesday, 75 basis points priced in. We have the 10-year yield coming back up almost 6 basis points, but it had fallen dramatically over just a few sessions last week, so we're at 280.87 right now. And NYMEX crude turning back around, heading higher from where we saw just a half hour ago, up about 82 cents a barrel to 95.50, still holding well above 100. And then Bitcoin finally down 3% from yesterday. Also Friday, we had a really strong day. It was well over 23,000, but it's still at 22,024. Kaylee, what do you see in terms of the pre-market movers?
Well, a lot of them are tied to that move lower in Bitcoin, and that crypto-related equities are under pressure. The likes of Marathon Digital, which is down 2.3%. Coinbase, the big exchange, is down 1.6% as well. And interestingly, you're seeing some pressure in the energy space, even though oil is just a little bit higher on the day. Where the real weakness is coming from is actually the oil field services. Their likes of Baker Hughes and Halliburton, each down the ballpark of 1%, though we know that some of those services companies are facing supply chain issues, inflationary pressures. So goes the story with so many companies in this kind of environment, Anna.
Absolutely. Kaylee, let's have a look at what's going on in European equity markets. So after starting the day in negative territory, we've managed to turn that around, up by just 0.1%. So much still lies ahead of us this week, from the Fed to the earnings story. So maybe a pause for thought in the meantime. Did we make too much of those moves in bond markets last week? Did the markets make too much of those? And the weakness of the data, which drove investors into the perceived safety of government debt. We're unwinding just a little bit of that at the margin today. That's what we see on the German 2-year yield. Philips is really interesting as an earnings story, one to get this week started here in Europe, down by 10.7% on the back of the earnings report. And it really is concern around their supply chains and China that still is weighing on this company, along with some other issues. But that's a real reminder to us that we're not through the COVID concerns. Of course, those policies still in place there. And Eutelsat, this is down by nearly 17%. This is an interesting European attempt to try and build some kind of rivalry to Elon Musk and SpaceX, long behind, or far behind in that endeavor, of course, but interesting that they're still attempting to do so. And this is Eutelsat trying to do a deal with OneWeb in the UK, but there are so many government shareholdings in here that it does seem as if it could be a long slog to getting some sort of M&A done in that space, Kaylee.
All right, maybe a lot of red tape to cut through, Anna. Let's keep the conversation on Europe. Joining us now is Mark Anderson, UBS co-head of Global Asset Allocation. Mark, there's just a couple bits of news out this morning. On the one hand, you had IFO confidence in Germany falling to the lowest level since the early days of the pandemic. At the same time, you have Martin Kazaks of the ECB saying that the 50 basis point move we saw last week shouldn't be the only front loading. They think another rate increase in September also needs to be quite significant. This is an ECB that the data is telling us is hiking into weakness. Can you touch Europe with a 10-foot pole right now?
I think Europe is certainly a difficult place to invest. I think you mentioned all the important ones. So we see the IFO definitely down today. The expectation component is reminding us that a European recession is certainly a high probability event. ECB hiked 50 basis points last week. They're likely to do it again at their next meeting. So with this kind of backdrop, obviously European equity markets have suffered year to date and quite significantly, are down trading with a 20% discount to kind of its US peers in some of the sectors that we compare it to. So a lot is also in the price, but we think that European equities are likely to be more flat towards the end of this year. We have to be very selective where we take our picks, and we are likely to need to see kind of a bit of an earnings reset, so to speak, in order for broader markets to move more significantly higher.
Well, on the subject of earnings, you think earnings are needed to move the market higher, but are earnings expectations already too high given some of the inflationary and growth pressures out there?
We do think that current earnings expectations are a bit too high in terms of where we think they will ultimately come in, both for the end of this year, where we have kind of a 7% expectations for 2022. Next year, we would expect to see earnings down at around 5%. And here the market is still significantly above our estimates, some 10-15 above where we are. And it's a little bit of a mixed situation to some extent, where you could say, well, earnings are supported by higher top line growth. Inflation is to some extent supportive for European companies. So is a weaker euro for those companies that are exporting their way out of some of the pain. But at the end of the day, ECB hiking, high risk of a recession, input costs moving higher, margins being squeezed, ultimately in our view means that earnings are likely to be downgraded further in our view, and therefore that's a lack of a catalyst for what's otherwise a relatively cheap market, but not yet something that we go in and buy in full scale here.
Are financial conditions tight enough, Mark, that it concerns you, or are we a long way off from that?
I think financial conditions have certainly tightened quite a lot, and I think what we've seen and what central bankers around the world are probably pleased to see is that these tightening financial conditions are also causing the PMIs to slow. In the US, we're seeing initial jobless claims moving higher as a bit of a signal that the labor market is slowing as well. And this is ultimately what they're trying to achieve through higher rates in order to get inflation and inflation expectations somewhat down. We haven't seen that happen with kind of the core inflation readings happening just yet, but at least on the inflation expectations component, we are seeing markets moving a bit in that direction. We saw yields coming down a bit last week as well. So I think they're at least seeing a degree of confidence with markets expecting that they will have inflation under control. And we're also seeing a little bit, I think, last week of bad news being good news in the sense that yields came down off of these kind of weaker macro data, but therefore also supporting equity markets.
We see the Bloomberg dollar index coming back down to 1273. How much of a problem is the higher dollar, the stronger dollar for European companies?
So I think the stronger dollar, well, you can say that has certainly been a bit of a support just in terms of exports. In a way, whatever they're selling towards the US or emerging markets, Asia for that matter, has come with a little bit of a tailwind. So I think that is somewhat supportive. Now, I think the issue might be that if the ECB starts a bit more of an aggressive hiking cycle, and you had an interesting interview on that topic earlier today, we could see that the euro might start to strengthen a bit again, just at a time where the many European companies could actually be supported by this weaker euro environment.
Can I ask you about, Mark, about investments in technology stocks? We've heard a bit from various voices in the tech sector. We've heard some earnings. We've also heard some talk about job cuts. Are there any parts of the tech space, at specific areas within tech that you think have some upside from here?
Yes, so maybe the way to start it off is that we've certainly had a little bit, let's say, less favorable view on tech or growth-based companies, so generally speaking for the most of this year, and still have a tendency to like value. With that being said, obviously tech has seen a kind of a significant sell-off, and we do look to those places where we have so-called long-term investment themes that are benefiting from this. So parts of the tech space that could be around security, so IT security or similar is just one where we have kind of a broad investment theme around security that both links to energy security, defense, etc. But here, kind of IT security is another topic as well. That is something that we do like. Yeah.
Thinking more broadly about the U.S. economy, Mark, we heard from Janet Yellen over the weekend, Treasury Secretary. She was saying that recession is a broad-based weakness in the economy, and we just don't see that yet. And that harks back to some of the comments we got from other Fed officials saying, are we really going to see a full-blown recession when unemployment is as low as it is, the labour market as tight as it is? What are your thoughts on the likelihood of recession in the U.S.?
Well, to some extent, you could, of course, say, well, we've been at a place now with so low unemployment rates, extraordinarily strong growth for the last, call that, 12, 18 months or so, that it's difficult to look into the eyes of what potentially could be a recession. But recession typically comes at the turning points, right, where we've come from a lot of strength and now it's weakening. And I think what we are seeing, and I think getting confidence from the initial jobless claims, the PMIs that were out last week, is that we're seeing significant slowdown in the U.S. economy, which, frankly speaking, I'd be very surprised if it didn't, because we still have oil prices significantly up over the year. The Fed is tightened now. They will likely go into neutral territory with rates, another 75 basis points of hike, getting us into 2.25, 2.5 on the Fed funds rate, which is close to neutral territory. So significant tightening of financial conditions, higher energy prices, etc. So it would almost be strange if we were not seeing kind of a slowdown, a potential recession, frankly speaking.
Well, of course, Mark, you're seeing concerns around a slowdown reflected in the bond market, in that the 10-year yield is trading right around 280, about 70 basis points off the high we saw in mid-June. As we see that bid coming back into the bond market, there's a conversation now about the revival of the 60-40 portfolio, which earlier this year had been declared dead. Is that still a strategy that works?
I think we're certainly seeing that there is some value coming back into fixed income markets. So for many of our clients here with UBS Global Wealth Management, we have kind of called fixed income more or less a dead asset class for several years, and this one is now back. We're seeing value coming back into not only treasuries, but kind of high-grade bonds around the world. And we're seeing a lot of our clients that are seeing a bit of interest in it. So yes, it's adding a diversification that we have probably lacked in the beginning of this year, where the very, very low interest rates and the high inflation environment essentially saw bonds and equities down at the same point in time. Now bonds can finally give us a little bit of potential diversification if we're seeing an economic slowdown beyond what we have been doing for our clients around adding obviously alternatives, be it around hedge funds, private markets, which is something that is significantly interesting asset classes for our clients these days.
Okay, Mark, so as we're talking about how to construct a portfolio, there's also a question of how much money you put into the portfolio. How do you feel about cash? Is the time to hold it over? Is it starting to be time to put money to work now that there has been a lot of value creation this year?
I think it certainly is time to put a bit of money to work if you had a bit of an excess cash at this point in time. And certainly if you're a very cautious defensive investor, I think there is value in the safe part of the bond market now all of a sudden, where you're no longer going to lose your shirt like some investors might have done from the earlier part of this year. But broadly speaking, with equity markets as well, a diversified portfolios are still likely to give you a nice positive return, which is, in our view, still quite a bit above kind of cash rate. So that's certainly something that we recommend our investors to do.
Mark, thanks very much. Thanks for joining us. Mark Anderson over at UBS. Coming up on the program, the WHO, the World Health Organization, sounds the alarm on the spread of monkeypox. So, Dr. Catherine Smallwood, the organization's senior emergency officer, joins us next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Surveillance. This is the early edition, but coming up is the original, and co-creator, co-anchor Tom Keene of Bloomberg Surveillance joins us now. So, Tom, what have you got on the docket today?
What we're going to do is recalibrate. Lori Calvasina is with us. Yeah, we've got Rubini. We'll talk about that in a moment. But much more, we've got Lori Calvasina to start the show to say, where are we? After the heat wave, I think I need to ask, where are we? Let's look at the chart. This is a chart we've used many times. Yellow is correction. Down 10%, red is bear market. The pandemic, up we go, recovery, we've rolled over. But we are sort of in betweeny, Matt, is how I'd put it, between correction and the drawdown from the peak, December-ish, is Standard & Poor's negative 17%. Dow does a little better. NASDAQ on a chin there, with some NASDAQ doing quite well, but many others struggling.
Yeah, and as you say, Tom, Lori Calvasina turning less bullish, cutting her year-end target for the S&P to 4,200, even though you're looking at the Dow. Meanwhile, Mr. Rubini, what's your top question for him?
Well, we've got to talk about Europe. The charm of Nora Rubini, Kaylee, is he's old world. And we've really got to talk about the European continent, the news flow over the weekend, and really how the war links in with what we see in economics, finance, and investment. I think that'll be good perspective from him.
Tom, thanks very much. Really good to speak to you, and we look forward to that program. Tom Keene, co-anchor of Bloomberg Surveillance. Let's go back to the earnings story here in Europe. Philips has cut its sales guidance as inflationary pressures, supply chain troubles, and COVID lockdowns in China led it to miss earnings estimates in the second quarter. We spoke to the CEO earlier.
The second quarter was impacted by a lot of headwinds. We had China lockdown, supply issues, and rising inflation. We have taken decisive action in terms of further improvements on the supply chain, as well as productivity and pricing. We see for the second half of the year a 6 to 9% growth. That is underpinned by a very strong order book. In fact, orders continue to come in. If I disregard China for a moment, we saw 6% order growth and 19 more hospital groups signing up for long-term partnerships. So orders here is not the issue. We are well placed. We just need to get the supplies and the chips, as Manus just said, in place to deliver on that strong order book. We expect that we are able to do that much better in the second half than in the first half, leading to a 6 to 9% growth in the second half. Still, for the full year, that means indeed a 1 to 3% revenue growth and an EBITDA of around 10%, which is lower than what we had anticipated before.
Okay, so that's the table. You say leave China aside for the moment, but the world is obsessed with what's happening in China in terms of supply chains and economic delivery and recovery. What needs to happen in China and in Asia to materially unlock the blockages?
Yeah, I'm certainly concerned. In China, we saw this massive lockdown that lasted for more than 2 months that affected the China revenue itself, but also further disrupted global supply chains. For example, we have factories in the Shanghai area that were affected. What I understand from the situation now, that it is improving and these massive lockdowns will probably not happen again, but still the risk is there. I really hope that we can see, let's say, a further relaxation of the policies, because we are all dependent on supplies out of Asia.
That was the CEO of Philips, Frans van Houten, on the company's outlook for the second half of 2022. Really interesting, Matt, that he is, he's reminding us that we're not over the COVID disruption. Supply chain issues coming through from a very disrupted China in places, still very much at the center of things for some of these European corporates.
Yeah, absolutely. And we saw a survey over the weekend that most manufacturers think supply chain disruptions are going to continue into 2023 and beyond. So it still is a huge problem weighing on the global economy.
Yeah, and I wonder how much color we may get into that with Apple results coming up later this week, Anna, considering they're exposed to China on the revenue side and then also those very same supply chain issues.
Yeah, absolutely. So any more clues on that, very welcome, of course. As I've actually been noticing that shipping rates, those freight rates for crossing the Pacific have been coming down. Does that tell us anything useful in that regard? Coming up, the World Health Organization sounds the alarm on the spread of monkeypox. Dr. Catherine Smallwood joins us, the organization's senior emergency officer. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I do think monkeypox can be contained, absolutely. The way we contain monkeypox is we have a very simple, straightforward strategy on this, right? Which is make testing widely available. We have done that, and now testing is far more frequent and common. We're going to be releasing hundreds of thousands of more vaccines in the next days and weeks. So there is a very substantial ramping up of response that is happening right now.
That was the White House COVID response coordinator discussing monkeypox on CBS's Face the Nation. The head of the WHO has declared the monkeypox outbreak a public health emergency of international concern. The virus has spread to about 16,000 people in more than 70 countries. We're joined now by Dr. Catherine Smallwood, Senior Emergency Officer at the WHO. Dr. Smallwood, thanks for joining us. We've gone from a handful of cases to 16,000 known infections in a short period of time. Are we capturing all of the infections? How big could this problem be?
It's likely to be bigger than what we know, and that's partly because of the difficulties in some countries in ramping up the surveillance. It's also partly because we're pretty sure that a lot of people with symptoms and signs of monkeypox might not be presenting early enough to be tested. So we do anticipate that we're seeing the tip of the iceberg here. But let me reiterate that it's still very much focused in a particular group, men who have sex with men and associated with people who are having a lot of sexual contact with a lot of different partners.
Dr. Smallwood, what we've seen with COVID-19 is its ability to mutate, and the creation of new variants is what is spurring new waves of infections. What do we know about the genomics of this virus in particular, and whether or not it is mutating in a similar way that could make it more infectious and widen its spread?
Well, we're looking at why this monkeypox outbreak is spreading in a slightly different way than we had previously seen it spread in countries where we are used to seeing it spread. And so different mode of transmission or previously undocumented mode of transmission, which is associated with sexual contact, seems to be driving the cases at the moment. We don't know whether that's a result of the change in the virus. It's a DNA virus. So as compared to the SARS-CoV-2 virus, it should be more stable and less prone to rapid mutation.
In terms of fatalities, I mean, what do we know about how this disease affects people? Isn't it unlikely to kill, and what are longer-term ramifications of getting it?
Well, we don't know about the long-term sequelae of monkeypox, and we're learning very quickly very many new things about the disease over the past 2 months. So that's one particular area of uncertainty at the moment. But thankfully, as you say, there's only a few deaths associated with monkeypox this year, none in the over 12,000 cases reported in Europe. We've seen no deaths reported so far. We have seen people hospitalized. So it's a less severe disease than something like COVID-19.
Okay, and vaccination is an effective tool to prevent infections. Do we have enough vaccines?
No, we don't. And certainly we're worried about the availability and the equitable distribution of vaccine across the world. We also need to work very, very quickly in gathering the evidence base for the vaccination because, of course, we're using smallpox vaccine for monkeypox, which is based on extensive studies in animal models, but we still need to have the real human data. And we're looking at countries to really ramp up the research around that, and that's partly why we've declared this a public health emergency of international concern.
Okay, thanks very much. Thank you, Dr. Catherine Smallwood, Senior Emergency Officer at the World Health Organization. That is it for Early Edition. More surveillance is ahead. A stellar lineup of guests coming up with Tom, John and Lisa in the hours that follow this one. They'll get you ready for that Fed meeting a little bit later on this week and indeed take you through the preamble to all those earnings reports we're going to get this week. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
To do its job, get inflation down.
The Fed is hiking interest rates into a known slowdown in the markets. This is something that they don't normally do.
We have heard from a lot of companies that they're thinking the following environment is going to be more challenging.
High inflation and policy tightening raises the prospect of a pretty significant slowdown.
We're seeing signs that global economic growth is decelerating at a pretty rapid clip here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Breaking news, Bramo is back. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures up 0.5%. TK, big week ahead.
Big week ahead. The Fed meeting there. We're getting ready for a show. We have a terrific lineup of guests to give you perspective on the Fed show, but we got to get there first. And to me, it's the recession debate over the weekend. I thought a really rich weekend of research. Ben Laidler, he's been so good on staying in the market. He says recession is not inevitable.
Tell me, it's the distance to September 21st. It's the meeting after this meeting.
I totally agree.
If this is 75, is it the final 75 basis point hike from this Fed?
Long ago and far away, and of course, there's an election coming on. It's a mid-year term. I'm going to go FOMC go. You know how to do that, John, on the terminal. We got to get Lisa reacquainted with the terminal. November 2nd after September 21, ever more important, too.
It's been a while, hasn't it, since we said good morning, Lisa? Let's say good morning, Lisa, right now. Good morning, Lisa.
I hear that I was, hiking on Mount Everest and checking my
You're a base
oxygen
camp.
level?
We wanted to keep it realistic.
I love it.
We did.
Thanks, I appreciate that. It's good to be back, and it sounds like as I was gone, it was more optimistic.
Did you get a headache?
Shocking, right?
Did you get a headache coming back on Cutter through,
I thought you were going to ask whether I got a headache coming back on the show. I will say it does seem to be a little bit more pessimistic out there than it was last week, and I wonder how much this has to do with dollar weakness that has been a sort of ongoing theme in the wake of the ECB, and how much that's given a lift to a lot of the risk assets that, when I was around, weren't doing so hot.
Let's complete the A block, then we'll give you a migraine. Futures this morning, good morning. Up 0.5% on the S&P 500. On the NASDAQ 100, up 0.5% also. Yields look like this, up 5 basis points at 279.95. We need to talk about the data. Pretty terrible on both sides of the Atlantic. The PMIs last week. This morning, German business confidence, pretty brutal too. Euro dollar 102.40. Lisa, the euro showing just a little bit of strength this morning.
To me, that was the big story of last week, and I understand that I was probably hiking in Mount Everest or wherever I was. That, however, I was tracking, and it seemed like that seemed to be the big shift. Euro strength suddenly after so much weakness. Today, not a huge day, but this week, John, as you said, a monumental week for the United States. Last week was all Europe. This week, all the U.S. We've got big tech earnings throughout the week. On Tuesday, we've got Microsoft and Alphabet, Google, Tom. I know you're not going to like Alphabet. And then on Wednesday, we get Meta, Facebook, as well as a slew of some of the software and hardware providers. And then later on in the week, we get Apple and Amazon on Thursday. On Wednesday, the FOMC rate decision and press conference, the key issue people are talking about. As you pointed out, both of you, it's not the 75 basis point rate hike that everyone's expecting. It's what happens in September, and how does this this Fed calibrate the dual mandate of both getting down inflation and dealing with an unemployment rate that has to rise if they want to get that inflation rate down? And that seems to be the tension that a lot of people are looking for some guidance on. And this week we get a slew of economic data, including on Thursday. This is what I'm really interested in. The U.S. second quarter GDP figure. Does it come in negative? Are we already in a technical recession because we did have a negative GDP print for the first quarter? How much does that shape the view, especially because it comes the day after the Federal Reserve? And then on Friday, we get the ECI, that employment cost index. And John, you remember how in the last couple of meetings, that's been a key indicator for this Federal Reserve. Are we starting to see the cost of employment go down, or is it continuing to accelerate?
Good job it didn't come before the meeting, because we might get that Wall Street Journal story again ahead of the meeting, 2 days before it, and whipsaw us all.
No,
Ramo, thank you. Nothing at all to see there. Lisa, thank you. Tom, looking ahead to GDP on Friday. Bank of America, TD, Deutsche Bank, Nomura, just going through some of the estimates, all looking for that second quarter of negative growth.
Well, it's the second quarter of negative growth, but I'd say it's a pretty high dispersion. And again, it gets recalibrated along the way, a second look and a third look as well. But I take the point that the economic guesstimates are going to fold right in to what the stock market calls will be.
We have a new guesstimate, a new stock market call, Tom. S&P 500 year-end price target 4,200, down from 47. It's Laurie Calvasina of RBC, and she joins us right now. Laurie, great to catch up with you. Why the downgrade? Let's start right there.
So look, I think that targets are always challenging in years like this. And frankly, the market broke lower than we thought it would earlier in the year. What we wanted to do with this target was signal that we do see upside between now and year end. We think there's a decent chance stocks bottomed in mid-June. And if they didn't, we think we could probably get that before the end of the third quarter. But really, we wanted to send the signal that we thought there was some modest upside between now and year end, that we do think you need to be leaning into recession rebound plays as opposed to really kind of leveraging up on the defensives here, which we think are overbought and oversold. I will tell you, John, that some of my sentiment models tell us that my original 4,700 target's probably still the right one. But when we look at our cross-asset analysis, stocks versus bonds, that really does temper our enthusiasm a bit.
Laura, this is important. Davide Serra over in Europe this weekend aggressively writes, take risk in credit. Serra says grab a 6 to 7% coupon, get your foot in the water, let's go. You're saying the same thing on recession rebound. Yeah. What does a recession rebound sector or part of a sector look like?
So some of the areas that typically do well are things like financials and technology stocks. These are areas that typically underperform in the drawdowns and outperform on the rebounds. So those are two areas we like. We think the financials are dirt cheap at this point in time. Our banks analysts are very, very constructive and think that even if we do have a mild technical recession, that banks will execute very well through it.
Then how will you use the GDP statistics in review this week? I get it's a first look and all that, but if the banks are doing well, that means we underestimate the resiliency of the consumer. Do you buy that line?
I think that the banks are telling you, if you look through some of the reports that we've seen so far, is that the consumer is at a very good starting point to weather whatever this economic storm ends up being called. And I think that's one of the lessons that equity investors have learned over the last 4 or 5 years, Tom, is that every time we enter one of these dicey periods in the equity market, whether it was the trade war, whether it was the pandemic itself, whether it was simply sluggish growth out there, that the consumer is pretty resilient. And that consumer starting point does seem to be very, very strong right now. I think that's getting lost in some of these recession discussions.
So, Laurie, the big theme then, am I playing the inflation story still or pivoting to slower growth? Which one is it? A bit of both or one or the other?
I would a little bit of both. You know, we get asked a lot about stagflation, and what we've told people is that we do expect inflation rates to moderate, but they could stay high relative to history. For that, I think you want to keep some energy in your back pocket. I'm a little bit, concerned that we may not be out of the woods on energy in the very short term. But longer term, if we are in that stagflationary environment, I think you want to play there. I think that technology is a great way to sort of play that slowing growth theme. And we do see the market starting to shift away from these overvalued, overcrowded defensives back towards more reasonably valued secular growth areas of the market, like big cap technology. And I think that one of the things we've learned the last few years is that these big cap software companies in particular are the tools that companies use to fight just about whatever battle gets thrown their way. So if you think that we're sort of hitting the bottom in here, that we're going to get perhaps a better path from the Fed, that the consumer is going to stay resilient, but things aren't going to be all roses and sunshine, I think technology is an area you really do want to look at very hard.
Lori, how do small caps fit into this, considering that you're now going overweight small caps heading into what most people think is a U.S. recession?
So look, I think you have to really evaluate what do you think has been priced into different points in the market, different parts of the market at this point in time. Covered small caps for a long time, Lisa. We know that they always have a very hard pivot midway through recession. They tend to really underperform hard heading in and on the way down initially, but they tend to really experience that pivot and outperform in the late parts of recession and on the way out. What we see in particular when we look at small cap performance against economic indicators like jobless claims and ISM manufacturing is that small caps are already trading as though we've had a spike in jobless claims and as though ISM manufacturing has plunged and hit typical trough-like levels. So I don't really need to have the are we having a recession, when is it happening debate within small cap. They are already pricing it in, and it's more clear to me in that part of the market than just about any other part.
Do you think that this means that small caps are ahead of the rest of the market, or is this a leading indicator that we're already in recession is going to get confirmed on Thursday with that second quarter GDP print?
I think it's going to be interesting if you do get a negative GDP print for the quarter, whether or not people view that as a recession. I think that debate will rage on. But I do think that small caps are very economically sensitive because they do have primarily most of their revenues coming out of the U.S. So if there was a technical recession in place, small caps were going to have sniffed that out. And it will really make sense, kind of the carnage we've seen in that space, frankly, since March of last year. It could make that, kind of move that we've seen make a lot of sense. But frankly, Lisa, it already makes sense based on what you're seeing in ISM manufacturing right now.
Lori, great to catch up with you, and thank you for issuing the downgrade before the appearance, and unlike some guests who do it after the interview. Yes. Lori Calvasino of RBC. Tom, I never understand, what's that about? You come on for the interview and then you cut your forecast.
It's about lawyers.
An hour later.
This is really important question, John.
Clear it with them before.
What are you talking
It's about lawyers. They don't want to get out front with the media. They've got to get in a process where it's proved up the food chain, and then it goes out to clients first. It's really, really serious.
Just want to bring out this headline for everyone. It's from Greece. Last week, the EU came out with this proposal to cut gas use for the continent through the rest of this year. And we talked about the potential for tension between the south and the north, the core and the periphery. Lisa, this from Greece. We can't accept the EU proposal for a 15% reduction in gas use.
So we have this idea that the European GDP could get cut pretty dramatically if Russia cuts off gas supplies, especially if it's a cold winter. So trying to get ahead of that. And already you're seeing countries push back and say, come on, guys, really? Give us a bone, throw us a bone. Do we really have to do this? And it raises questions about longer term, how they can really build supplies ahead of what could be a cold winter.
Well, the data's already terrible. Let's put it that way. German business confidence has really rolled over. And Tom, the tension's pretty clear between a hawkish central bank and some weak economic data in Europe, and for that matter, in America too.
And then the war. I think over the weekend, I read a lot of the war over the weekend, John. And I think there's a massive case of the war being distant, the war being removed from London, removed from New York, and that's probably at your hazard.
Euro-dollar 102.38. Lisa, welcome back.
Thank you.
Did you see the level of gloom there? John, I think the gloom clicked in about 6:01.
In TK, she came bouncing in.
6:01.
Bouncing, smiling.
She just rocked
She was so happy.
It was just great gloom, and there it was.
Then the show started.
That's Wall
It was
Street
about 6:01.32.
It was.
Oh, come on. I was smiling, though, as I said it.
It was smiling gloom.
We appreciate the smiley gloom. Futures up 0.4 on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The European Central Bank may not be done with big increases in interest rates after last week's half-point hike. Governing Council member Martins Kazaks has told Bloomberg that the rate increase in September also needs to be quite significant. The ECB is trying to reduce inflation that is already more than 4 times its 2% target. Now, Treasury Secretary Janet Yellen says she does not see any sign that the U.S. economy is in a broad recession. Yellen has told NBC that the U.S. is likely to see some slowing of job creation, but said that isn't a recession. She also expressed confidence in the Federal Reserve's fight against inflation. Here in the UK, Liz Truss says if she is the next Prime Minister, she would introduce low-tax investment zones to spur economic growth. The Foreign Secretary is leading the polls to succeed Boris Johnson. Her rival in the race, Rishi Sunak, has pledged to crack crack down on China's influence in the UK. He calls it the biggest long-term threat to Britain. The Director General of the World Health Organization has declared the monkeypox outbreak a public health emergency of international concern. The virus has spread to about 16,000 people in more than 70 countries in just a few months. There's concern that, as in the early days of the COVID outbreak, there's a lack of urgency and coordinated testing and treatment. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Look looking for another rate hike this Wednesday.
Central banker is basically going to take a sledgehammer to inflation.
But will the Fed be able to steer clear of a recession?
We've got inflation, we've got a bit of a weakening labor market, and we have concerns about recession.
Trust Bloomberg for the fastest coverage and exclusive analysis.
This year's people that are calling for inflation peaked are last year's people that called inflation transitory.
Bloomberg Surveillance, the Fed decides. Wednesday on Bloomberg, your global business authority.
I would say that we're seeing a slowdown. A recession is broad-based weakness in the economy. We're not seeing that now. I'm not saying that we will definitely avoid a recession, but I think there is a path that keeps the labor market strong and brings inflation down.
GDP is coming out on Friday. That was Janet Yellen, the U.S. Treasury Secretary, on MVC over the weekend from New York City this morning. Good morning. Here's the price action. Futures up 0.5% on the S&P. On the Nasdaq 100, up 5 or 0.6%. Yields higher too by 5 basis points, 280 on a 10-year. Crude up 1%, 95.65, and the euro showing a little bit of strength as we get a couple of ECB policymakers talking up another big move in September. Euro dollar 102.34, up 0.2%. TK, if we get that negative print on Friday for the second quarter, the second consecutive quarter of negative GDP in America, expect a ton of pushback that sounded a lot like Secretary Yellen over the weekend. Can you call it a recession when we just churned out 372,000 payrolls growth and we're looking for another 250 for July?
Reason to stay with us on TV and radio. Bruce Kasman's going to join, I believe, scheduled here. And JP Morgan really parses it out, John. And their nuance is, yes, domestic final sales seem to be a little soft, but they're looking for a surprise in export growth. We will get to that with Bruce Kasman. They parse out, I believe it's a 0.7% positive statistic. It was an odd weekend. It started with a heat. For those of you worldwide, maybe you're cool, calm, and collected. We are not. Anne-Marie Horton down in a warmer Washington is not as well. It's basically survival wherever you are. But within that was a jewel of an essay by Stephen Eisenberg. He's out of Yale Law, but far more out of Newsday. And long ago and far away, he was an advisor to John Lindsay, who ran New York City for a while. And most importantly, Stephen Eisenberg is 81. And it was the most emotional essay, Anne-Marie, by someone of that vintage, of Trump, of Biden, and he just said, give it up, announce one term now, and then you can act with a new independence. Is that in the zeitgeist down there, or is Mr. Eisenberg alone?
He seems alone at the moment because many Democrats, while they do not want the president to be the leadership of 2024 and the candidate, according to a poll just 2 weeks ago from the New York Times, I think it was about 64% of Democrats say they want a new candidate for 2024. What you see in this Washington Post opinion piece, which is just quit, telling the president to quit, is that he thinks that this would give him actually more freedom to come out and have more conviction in what he says, but then also at the same time, instead of whispers in corners of Washington, people able to actually come out and prepare a bench.
I mean, you're living this. The guy mowing the lawn behind you at 1600 Pennsylvania Avenue is very aware of the polling as well. Mr. Eisenberg talks about the urgent present. If the president came out and said, I'm one and done right now, what is the urgent present he must deal with?
Well, he's talking about the fact that he can come out with a lot of conviction and just deal with the issues at hand and not worry about the politics of 2024. The issue, though, which many advisors, I'm sure, would be telling the president, is that you then automatically become a lame duck president. Right? If you're not running in 2024, you become a lame duck president. But potentially what could help, and this is what the essay talks about, is that this could help other Democrats in midterm elections, because then potentially they're not voting on whether or not they like what is happening right now with the economy or a referendum on the actual individuals sitting in the White House. They could vote potentially on those people running for legislature, whether or not it's for Congress or for Senate, and actual policies.
Anne-Marie, how vulnerable is President Biden after pinning a lot of his campaign to bringing down gas prices? Right now, that looks good, considering the gas prices have gone from about $5 on average per gallon down to $4.36 per gallon. How much do we look at something that is incredibly volatile, not in the control of the presidency, and could shift ahead of the midterms?
Well, this was obviously a huge goal of the administration. They wanted to quickly get gasoline prices down, especially during these crucial summer months when a lot of people are taking to the roads. And they were able to manage that. I mean, coming off a $5 handle is, for them, a huge milestone. And you could see that in the president tweeting constantly every time you see the cents tick lower on gasoline. Whether or not it has changed the psyche of the voters before November remains to be seen, but it's something that obviously they wanted to quell because they just do not want this grumbling of people complaining about gasoline prices, but also gasoline prices filter into everything else, right? This is a broader inflation story that they're trying to combat.
Lisa, energy companies are getting less greedy. That's what's going on over the last month. The efforts, I mean, surely it works the other way.
Well, okay.
Surely it works the other way.
Okay.
Does it not work the other way?
I get your point. And this is going to be something that's increasingly perilous as somebody tries to drill down and get some sort of logic behind some of the complaints that this White House has had. And I know that you'll be one of those people.
Well, if you spend months saying they're greedy, surely they're getting less greedy when prices come down, because that's all that drives prices, just the greediness of corporate
to that
America.
point, do you know that Friday we get Chevron and Exxon earnings? So we get a chance
We'll see
to
the
hear
greed of those
or
companies
not, or
later
perhaps they're getting less so.
We
Maybe
get
we'll
the
hear from
greed
the
of
White House.
Apple later this week too. I just need to point out that GDP is on Thursday, as Lisa told you at the top of the show, and ECI is on Friday. So just quickly to you and AMH, if we get that negative print, did we get a hint from Secretary Yellen about how they might handle that?
I think that her interview over the weekend was certainly looking ahead and foreshadowing what they're expecting on Thursday. All the data in front of us shows this is likely going to be a technical recession. But what they're trying to, of course, get ahead of that is that, yes, maybe technically the U.S. Is in a recession, but that does not mean that there is this massive amount of slower growth, especially, and I'm sure they will say this, when you comparatively look at what is going on in other countries, namely in Europe.
Yeah, hard to call it a recession with unemployment at 3.6%.
Yeah.
That's for sure. Anne-Marie, thank you down in D.C. We'll catch up with you in about an hour. Reflecting on some of the data we've had so far, the PMI services number last week, Tom, was dreadful. I mean, it was terrible. If you take out the pandemic months, and the team here at Bloomberg did that over the weekend, it was the weakest in records going back to 2009. That's how bad it was.
Yeah, I'll take that. It's back 12 or 13 years. But to look at the equation of GDP and the mix here, John, there's a part of America that's, even if we have a technical recession, whatever you want to call it, they're going to be fine. There's a huge part of America that the president has to address and others that's going to be flat on their back. And I would suggest, John, is flat on their back now. What we haven't talked about is one single item of inflation, and that is rent, and particularly lesser home sales shifting over to new renters.
How sticky will things get? And I think out of everybody, Lisa, you've done a great job of pointing that out over the last couple of weeks. That's going to be a big theme into year end.
A lot of people have been looking at that. How much are we looking at a technical recession that keeps unemployment low? How much are we looking at something more protracted, and that's tied up into the stickiness of inflation?
Futures up 0.5% on the S&P, on the Nasdaq up 0.5% also. Live from New York City this morning. Good morning. Heard on radio, seen on TV. This is Bloomberg Surveillance.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound.
Okay.
And that crack is a sonic boom.
Yeah.
I think the way they got a date was to impress the females by making loud booms.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I've always said it, the conversations in the commercial breaks with the guests are so much better than when they come live on air.
Well, I want to do that, John.
Why is that?
I want to do it like Sports, John, where you go big box, little box.
We should do that.
And we show the messaging. Thank you to our great advertisers down low.
With the mics turned up.
You know, they watch me stirring Tang and the rest of it.
I'm sure they'd love that, Tom. Futures this morning. Good morning to you. Up 0.5% on the S&P 500. Best week of gains on the S&P going back about a month. We caught up with Lori Calvasina of RBC, who does cut her call year end from 4,700 down to 4,200. Earnings key. This week alone, 20% of the index on the S&P across just 5 names. We'll talk a lot about those 5 names in just a moment. I want to talk about the tension, the growing tension between hawkish central banks and weaker economic data, and talk about a 2-year in America. Thursday, Friday, that 2-year came in 25 basis points, and that PMI on Friday was pretty bad. We bounced back just 2 basis points, just south of 3% to 299 on a 2-year in America. That story, though, no different in Europe either. Growing tension between hawkish central banks and weaker economic data. As they focus on inflation, the output numbers keep coming in. Look at the euro this morning. Euro doing okay with some hawkish central bank speak, maybe supporting things for now at 102.21. But the data again, it was the PMIs last week, Tom. This morning, the IFO index, which is basically German business confidence, just doing that.
Yeah, I think our American audience really doesn't care, but the fact is German yields with a vengeance have come in. And John, you know, I look at the Swiss 20-year, which came in with strong Swiss francs. So it's a movable feast in Europe, and I would suggest more movable right now, more dynamic than what we see in America.
For the multinationals, Tom, we've got to care. 1, earnings, and 2, FX. They're going to be important
FX
themes
is tangible.
This quarter.
Yep, no question about that. Okay, let's do this right now. Let us get a handle on where we're going to the Fed meeting, and that involves actually doing economics. At Columbia University, he took macroeconomics, kind of, sort of, 301, and Bruce Kasman joins us now from a small bank, J.P. Morgan, this morning. I love it, Bruce. Feroli says it's a kind of, sort of recession. What kind of, sort of recession is this?
Well, as you know, there's a good chance second quarter GDP will print negative for a second quarter in a row in Q2. As you kind of break down the data with job growth so strong, with what we continue to expect to be a positive consumer spending number in this week's report, it doesn't feel like a normal break into what we would call a recession. And I think we should recognize that about the first half. But at the same time, we should recognize the momentum loss that we had at mid-year. We're going to probably print a second negative consumption number in a row this week for June. As you've noted, the survey data for July, the flash PMIs were ugly. We're not just seeing that in the U.S., we're seeing it elsewhere, and claims are rising. So what feels like a technical event as we move through the first half of the year could easily turn into a real recession event as we go through the next couple of months.
In your spreadsheet, you've got a one-off on exports this quarter. Is it export growth to the rescue?
There is some support there, particularly as we see China and Asia lifting after what was a big second quarter set of lockdowns. But with the dollar rising and with Europe very much in the crosshairs of a recession right now, I would not be counting on exports saving us here. I think the saving grace has to be the business sector bending, not breaking in the face of the drags that we're seeing. Also, inflation coming off in the summer with gasoline prices starting to move lower.
Bruce, I'm looking at certain data points. You're looking at the same ones. Claims are higher the last few weeks. The PMI last week was really bad. We're starting to see this show up in housing. Yep. Bruce, I'm trying to work out which part of this is desirable, the intended consequence of what the central bank is trying to do, and which part of it is undesirable.
Well, I don't think the movement towards softer growth is undesirable on the part of the Fed. That's what they want. They want to slow the economy. They want to take out the demand component of inflation, and then they're hoping that with the moderation of some of the drags gets you back to something more acceptable. However, and I think this is really what's behind your question, the momentum lost there, the idea that layoffs are starting to rise, that's starting to push together a dynamic which traditionally has been recession. And recessions, we should understand in U.S. context, is a breaking. It's a move up in unemployment rates of 2% or more. That's the risk here, is that we're letting something take hold here that's going to give us a much sharper move than anything like what you might characterize the first half of the year as looking like.
Embedded in John's question, Bruce, is the fight that is articulated in an article on Bloomberg. The houses of Morgan divided, Morgan Stanley disagreeing with your own JP Morgan on when the Fed is going to reverse course, pause, and then start cutting rates after raising rates. At what point is the softening that we're seeing in data now reflective of a Fed that will be able to backtrack as soon as next year?
Well, I actually think it's far sooner than next year. We're looking for 75 basis points this week. We're looking for more open-ended guidance. I don't think they're going to commit to a size of a move at the September meeting. September's a tough call. I think we probably still do get a 50 at the September meeting. But beyond that, if we're seeing the economy really soften, job growth slow towards zero, I don't think the Fed's going to continue to be tightening here at an aggressive pace. We've got them pausing at about 350. We don't have them easing at this point because we don't have a real recession call in our forecast. But I think it's about the economy. If the economy starts to slow, given that the Fed gets rates into a modestly neutral stance, the equation changes at the Fed. It's not there today with a 175 level of rates and an economy